Are you ready to supercharge your wealth and unlock the power of passive income? Welcome to this episode of Dividend Discussion, where we embark on an enriching journey through the realm of dividend investing. Whether you're a seasoned pro or just starting out, this series is a gateway towards invaluable insights and firsthand experiences that will propel you towards financial independence. Join me as we dive deep into the minds of others in the dividend investing space that are eager to share their stories, mistakes, triumphs, and life-changing lessons. In each episode, we unlock the secrets of successful dividend investing, ensuring you can sidestep costly pitfalls and chart your own path towards financial freedom. Sit back, relax, and immerse yourself in this captivating episode of Dividend Discussion. Hello, everybody, and welcome back to another Dividend Discussion. I am here with my friend Kenyon. And Kenyon, if you wouldn't mind letting us know who we have the pleasure of speaking with, where you're from, and if you want to share your age, you can go ahead and do that as well.
Okay, what's up, everybody? Hopefully everybody's having a good day. My name is Kenyon Hackworth. I'm from Cincinnati, Ohio. Well, actually, I live in Cincinnati. Originally from Alabama. I am a chiropractor and also an educator. I husband, the dad of three beautiful daughters, and I'm here really to talk about investing. That's the most important thing that we're here for today, investing.
Yes, I like that. You got to love that. So real quick, what made you move you said from Alabama to Ohio?
Yes.
What made you do that?
Oh, that was 2004. So that's been um, almost 20 years. So I came here from Alabama. So I'm originally from where I'm from is a very rural area. So the first time I left Alabama, I came up here. I had family up here. So I came and I spent the summer with my cousins. I got really close with them. And one thing led to another. I came up here for a summer program when I was in undergrad for 2 summers in a row. So everything was almost like a transition, if you will, over time to me moving here. And I stay here now until eventually I move back to the South.
Oh,
So,
there you
and
go.
I'm 49. I forgot to say my age. I'm 49 for those who want to go in my age break. 49 years old.
Okay.
Just turned 49 2 weeks ago.
Well, there you go. Well, happy belated.
Thank you.
Yeah. So the reason I ask is because I'm actually from Pennsylvania and I moved to Oklahoma. So I always wonder like what causes people, because that's not like you move from Pennsylvania to Ohio or something like that, like one of them smaller moves. Like that's cross country, and you did the same thing. So it's always interesting to
Exactly.
hear that. So
Exactly.
that's pretty cool. Okay, so we must know what got you into dividend investing and when did you begin your journey?
Okay. So as far as dividend investing, from a dividend standpoint, it was in 2018. Initially, I started investing in 2007, and I did what most people do. I went and said, "Let me see who I can find to manage my money." So I went to one company first, and then they did it for a year in 2017, and then in 2018 I went to a different company. I wasn't happy with the fee structure, and then in December of 2018, Bernie Madoff got arrested
Mm-hmm.
for his Ponzi scheme. So when that happened, I was like, I had just started investing, and I know everything in 2018 because of the housing debacle. Everything was in the financial crisis. Everything was like really going down. So I was really focused on investing and things from that particular standpoint. And then when he got arrested, my question was, how can so many intelligent people have been duped for so long for him? And he's like a guru. So I asked myself a couple of questions. Number one, I said, if you don't know anything about investing, how am I to know whether this person who's managing my money is making a decision that is more beneficial to me or more beneficial to himself or herself?
Mm-hmm.
And the second question I asked was, can you ever really trust another human being with your money?
Yeah.
So from that standpoint, I said no. So in January of 2009, I transferred all my investments to Schwab, and I've been managing them ever since. I started out with mutual funds because everybody said mutual funds is safe, and I didn't
you mean
recognize that
by
that
when you say everybody, you mean Dave Ramsey?
exactly, exactly. Got to get your four types of mutual funds.
Yeah.
So, and then I started did that from 2019 or 2009 to about 2016, and then I started really looking at it as I started looking at the fee structure, and then I ran across Jack Bogle in an interview he did, I think, on PBS or something of that particular nature, when he talked about the compounding fees and how much that eats away at your potential money that it could potentially grow into over time. So from that standpoint, I said, mutual funds and that compounded fees, I did not like the fee structure. So I started looking at. Oh, so initially what happened was I used to listen to a show called the Mutual Funds Show because I used to always like, okay, let me see. I'm investing in mutual funds. I want to figure out what's the best ones, or how do I figure out what's the best ones. So, and then on the Mutual Fund Show, they said we don't invest in mutual funds per se. We invest in mutual fund managers. So when a manager changes, even if it's the same fund, it's no longer the same fund because you have a different brain
Mm-hmm.
that's actually in charge of the fund. So I wanted to look at who was the best mutual fund manager. And so I started looking around. It led me to Peter Lynch. And Peter Lynch ran the Fidelity Magellan Fund from 1979 to 1990. And over that 30-year period, I mean, a 13-year period, he averaged about 29% rate of return.
Mm-hmm.
So I was like, okay, I want to know what he knows. So I bought his book. And the first thing at the very beginning of his book, he said that he said this is where investors come to want to learn how to get my results basically. But the first thing he said, the first piece of advice he said was stop listening to professionals. So I stopped listening to the people on TV as far as what they say, invest this, buy this, invest in that. So from that standpoint, and also one of the things he said was that any human being using the customary 3% of their brain can pick stocks as well, if not better than the experts. So, that gave me a little confidence then if he's
Mm-hmm.
saying that. So the next step is I said, well, who is the best investor? And of course, that led me to Warren Buffett.
Mm-hmm.
And um, I call myself somewhat of a semi Buffetologist because I've listened to so many of his interviews. I've gone through his annual meetings so many times. So I really started picking up on his teachings, and that led me from one point to the next. And then eventually that got me into buying the individual companies that I buy. And from there, the journey just started, and now it's just, continuing to grow.
That's pretty cool. So, couple questions. I'm gonna ask both of them, and hopefully, one or both of us can remember both of the questions when you get to them. So,
Yeah.
first question is: when you said you first got started investing, you were doing the with an advisor, more or less, right? So, did you start investing because you've heard that you need to invest, or did you choose an advisor because you didn't know anything about investing? So you were like, hey, this person should know. I just know I need to be invested, or how'd that start?
I started because at that particular point in time, I met people who were like, me being a chiropractor, I've been self-employed for 20 years,
Mm-hmm.
and I grew up. When my dad was a farmer, my grandfather was a farmer, so nobody in my family really ever really invested that I know of. My initial family, so it was not something that was talked about. And then I got around, I met my wife, and she had a 401k, and I realized that looking at the 401k and me not having any investments, well, that was before we got married, and I realized I need to be start. I mean, I need to start investing. I was 33 at the time when I started, so I
Mm-hmm.
started late by most people's standards. So I realized that if I'm to have money in the future for myself, that I need to start investing. But then I said I don't really know anything, so we always got to find the professional to take care of our money because we believe, and we've been conditioned to believe, that they are going to be the best advocates for your money and make your money grow better than you, because we don't know anything.
Mm-hmm.
So you go and you find somebody to basically manage your money. And you say, oh, okay, I'm going to sit back and let them do it, and then you recognize over time, the more you learn, that you're just as capable or even more capable than turning your money over to somebody else. You can get much better results doing it yourself.
Yeah, yeah, that's one thing. Like any, of course, not professional advice or whatever, but anytime I talk to somebody that's not into investing, I try to express the importance and urgency of starting as soon as possible. The best time to start investing was yesterday. Next best time is today. So like, or I guess technically they say the best time to invest was 10 years ago, but the next best time is today. But like, I try to always tell them, I'm like, just get into an index fund, the VOO, the SPYs, something like that. And I'm like, worst case scenario, you never care enough about it, but your money is going to work for you. And best case scenario, you start digging into it. You're like, oh, this investing thing's pretty cool. I put in this much, it's now worth this. VOO pays you a dividend. You're like, oh, what's a dividend? And like, you start going down the rabbit hole and you uncover more if you want. And if you don't want to, you're invested anyway. Like the worst case is you're not invested at all. So that was kind of cool that how you did it too. And then the second part of that question I actually remembered was like, everybody I've talked to in this so far that does dividends, nobody starts with dividends. What do you think causes that? And like you said that you fell into Warren Buffett after Peter Lynch, like was Warren Buffett the reason that you got into dividends, or was that just the rabbit hole you went down afterwards?
No, well, Warren Buffett, he loves dividends, but he doesn't pay dividends.
Yeah.
Berkshire Hathaway.
Yeah.
So
Yeah.
I think that dividend, it just came about just searching through different methodologies of investing and continuing to read, continuing to learn. So getting into the dividend growth investing group that we in together. So reading books, the Ultimate Dividend Playbook. And there's so many different books I read on it. And it really came down to really just trying to build up a stream of passive income, using your money to buy assets, and then having those assets generate income that can grow every year without you having to do any extra work and put any extra. You can continue to add to them, but it doesn't require you to do anything extra. But the income continues to grow, especially if you invested in really really good companies.
Mm-hmm.
And that's what I look at. Looking at buying really good companies that can compound at a high rate for a long period of time, and I could just plant my seeds in the ground and just leave it alone, because money grows best when it's left to its own devices and not interfered with by us. The only thing we can do is mess it up by constantly moving money from one stock to the next, by this incessant need to, I need to move money here because this stock is undervalued this week. I'm going to move money here. I'm just going to keep on moving money around. The only thing that we can do is mess up this tremendous power of compounding. And compounding is so powerful that if we leave it alone and just allow money to grow, it's like if you plant a redwood tree, it starts to grow. When it takes roots and the roots get strong, you can have those storms that come, but that tree is rooted deep into the ground. It's the same way when you own a company for 4, 5, 6 years and it's built up, some value. Whenever there's a storm come, like last year, if you will, the sell off of last year, your portfolio value goes down, but you built up enough equity in it that it doesn't really hurt you that much in the long run.
Yeah.
So it's all about building and building and building and growing from that standpoint.
Yeah, I have so many people that are not in the dividend space that I talk to, and they either say that dividend investing is an old person's game, or when I tell them, I think Coca-Cola, I don't own Coca-Cola, but they're like, oh, when you buy a share of Coca-Cola and it pays you 46 cents per share per quarter, they always scoff at the low amounts, and I have not necessarily a hard time, but like it's not easy to convince them that like we're not focused on the today because we don't need the money today. And 46 cents per share is right now. That's also when I don't need the money, and it's going to keep growing, and I don't do anything for that 46 cents. So like that's the difference, is when you do get older and you want to have more time to relax, more time with the family, you don't feel like waking up at a certain time to work a certain job, and you want to just do your own thing. Be on vacation, get paid. Have a bad day, get paid. You're sick, you get paid. You get paid regardless. And all these people and all these companies are working for you to make the company more money, which makes you more money. So that's, I don't know, it's one of those delicate things that I try to portray to people the more I talk to them. But I mean, some people really get it and some people don't. So
yeah, there's a different term. Sometimes people look at quote unquote dividend investing, and they look at it from a standpoint of just the companies that pay dividend. For me, it's more about the companies that actually grow their dividends. I mean, there are some non-dividend companies that I own too, but companies that actually grow their dividends, where you look at the amount, it comes down to compounding. So if you can compound your money at a certain rate, for instance, if you compound your money around 15%, then your income, whether it's capital appreciation or dividends, is going to double about every 5 years. If you compound 18%, it's going to double every 4 years. So if you have income that's doubling every 4 years, it starts small, but then it begins to build up, and it can continue to grow and grow and grow. And then after a while, you recognize that snowball kicks in, and then your money is growing at such a rate where eventually your income will surpass your income from your investments will surpass your income from your job. And then eventually, if it continues to grow, it'll be even more than you've ever made in your working lifetime. That's the goal, to get to that particular point one day.
Yep. Yeah. I'm right there with you, man. I'm right there with you. Okay. So next question would be, how has your investing style changed from the time you began until today?
Well, initially, again, I started with the mutual funds.
Mm-hmm.
So because they were safe. Like now, I only own individual companies. I
Okay.
don't own any funds. I don't own any index funds. I don't own any bonds. You couldn't pay me to buy a mutual fund again.
Yeah.
So
Yeah. Yeah.
I just look for good companies that I can own and um, that's going to compound for a long period of time. I own 15 different companies. 10 of them I'm owned for 5 years or longer. And the longer you own a company, Warren Buffett said that the longer you own a stock, the safer it is, and the shorter the amount of time, the more risky it is.
Mm-hmm.
So when people jumping from one stock to the next based upon what the market is doing, that increases your risk from a standpoint of your actions that you're taking, trying to move money around all the time. But if you find a good company that you can buy, that you can own, and just let it compound, then the risk decrease because the risk really comes down to the quality of the business. So I was reading this book. I think it was a Tao of Warren Buffett, and then the author was talking about like individual companies and the risk factor associated with those. And she said that the risk comes down to two factors. The first one is the quality of the business, and the second one is the price that you pay for the shares in relation to that quality. The higher the quality of business, the lower the risk. The lower the quality of business, the higher the risk. Apple does not have the same risk as Peloton
Mm-hmm.
or Beyond Meat. Um, MasterCard and Home Depot, they don't have the same risk as Bed Bath and Beyond. So there's different companies. A lot of times people put stocks on the same level
Mm-hmm.
and said stocks are risky. I'm like, you gotta differentiate between what company you're talking about. You know, Apple had what $94 billion in cash on the balance sheet at the end of 22. So a company like that, just owning a company that generates so much cash, and you don't have to do any work. All you have to do is own the company, and there's really nothing to really manage if you think about it. Like I've owned Apple since 2016. Tim Cook manages Apple, so my money that's invested in Apple, guess what? Tim Cook, we as shareholders pay him a sufficient amount of money to create value for us.
Mm-hmm.
That's his job as CEO. The CEO is to create value for shareholders. So by owning the company, Apple is one, and a lot of other good companies, your money begins to compound and compound and compound, and you can really, really, really benefit over the long term. If you have a long term mindset and you don't freak out and you don't get afraid when something like 2022 comes along and your share price drops and you freak out, like, oh my God, I got to sell everything. If you're so fixated on stock prices and the buy low, sell high, and you focus on the stock prices, you're gonna freak out. When the stock price drops, like, oh, I gotta sell it before I go broke, as though the business that you have is about to go out of business. Stock prices go up and down over time, but good businesses, they tend to continue to grow over a long period of time.
Yeah, I think there's a statistic that says over a 30-year period, the S&P 500's never had a negative return in the
Mm-hmm.
history of the S&P 500. Well, I mean, that's obviously an ETF or tracking a major market, but it's kind of wild to think about it like that. If you're like you're saying invested for the long haul, historically over the 100 plus years that the S&P 500's been a thing, you would have never put in $100 and it would have never been worth less than $100 in that 30-year period, which is kind of cool to think about. So not to say it's risk free, but over like you're saying, over the long term, it becomes less and less risky over as long as you're giving it time and not touching it.
Exactly.
So I like that. Okay, so you kind of spoke on this a little earlier. Do you have any short term and long term goals that you're hoping to achieve with dividend investing?
My long-term goal is financial freedom, and I define financial freedom is when I have enough income from my assets that covers all my living expenses, and I don't have to sell any of my assets.
Mm-hmm.
That's the true definition of financial freedom. And then eventually get to financial abundance, and then get into more philanthropic stuff where I have so much coming in that it covers all my living expenses, and I'm able to give more to charity, because ultimately that's really what it comes down to for me in the long term. I would love to be like Warren Buffett, 90 years old, giving away a ton of money every
Yeah,
single
yeah,
year. So, but to be able to cover all my living expenses and to be able to really have control of my 24 hours, because you're not really financially free until you control your 24 hours. If you have to get up and go to work tomorrow morning, then you don't really control your time
mm-hmm.
because you have to go to work. If you can get to the point where your time belongs to you, where you say, I can sleep in, I can get up, I can do whatever I want to because I have income coming in that covers all of my living expenses. I don't have to answer to anybody. I don't have to get up and be somewhere at a certain time. Then that's super important. No, I always believe in continuing to advance, continuing to grow, continuing to learn. So I'm not really a believer in that retirement in the traditional the way retirement I
Mhm.
used to be. I'm not anymore. And even with my daughters, I started late, but they started early because they all three of my daughters have custodial accounts.
Mhm.
So because of it's three components that I look at for building wealth: is time, is dollars invested, and it's your CAGR. So time plus dollars invested plus your compound annual growth rate is the three components that build wealth. Investing. If you have more time, like my daughters are 14, 11, and 8, they have a longer runway, so it doesn't take as much dollars invested. If they doing $100 a month, by the time they're 35, they could easily have $1 million.
Mhm.
If I'm doing $100 a month, it's gonna take me 35 years to get there. I'm
You're gonna
already
need to make it to
49,
Warren
so
Buffett's age. That's what you're gonna need to
exactly,
do.
exactly. So if the time frame is different, means I have to invest more dollars to make up for the missed time. Or there's a combination of a higher compound annual growth rate because your money doubles faster, plus investing more dollars at the same time, we get you to your goal faster. So with time, dollars invested, and your compound annual growth rate, if you can control two of those in your favor, then you're going to get to your point. So that was one of the things I looked at because I started late. I looked at what can get me the highest compound annual growth rate on and still be safe, and how much I can put in. So the best way to get the highest compound annual growth rate, from all my research, is just to own really good companies,
Mhm.
and that way, and definitely to eliminate fees. So I don't pay any fees at all. Thank goodness that they went away from the fee structure
Yeah.
for all these. That's the one thing I like about Robinhood is they
Mhm.
made everybody else, get rid of fees. So by not having any fees or not, especially compounding fees, by eliminating compounding fees coming out of your account every single month, and by owning good businesses and just letting them compound, then you're going to benefit tremendously. Or I'm not going to benefit tremendously. And I've seen it in my own, especially when you see money that's grown at 20% or 25% over a 5 year period, and you see it's a whole different type of growth than what I ever had with mutual funds too.
Mhm. Well, I think that is like a barrier to entry, if you will, where investing to really understand it and really see the magic of the investments and the compounding, it does take time. And I feel like that's the barrier is a lot of people are like, oh, okay, if I gave you $100,000 or $1,000 today, what would that be like next year? And I'm like, well, I mean, you could turn it to this probably, but like next year's not the magic. The magic's 10, 15, 20 years from now. That's where you're like, oh my goodness, like that's the life changing amount. But it starts today. Like the first step's always the hardest. So like that
Exactly.
is we talk and you talk about Robinhood. I see a lot of people in the group like instantly. You mentioned Robinhood and it's an instant bash and I'm like, man, for everything that they do wrong, they've also blazed the trail in so many ways. You have the automatic investment. I was just talking to my cousin about this today. The automatic investments that you can put in. He literally had $1 a day going into Coca-Cola, just buying him little fractions of shares every day. And you can do that with however many companies, ETFs, or whatever you wanted. That's really cool. They got rid of the fee structures. I called this like, I don't know, probably a year or two ago. I said crypto trades 24 hours a day, 365. I think stocks will get there. Just
Mm-hmm.
be like you can see there's demand for it. There's people up at 2 a.m. trading crypto. Like there's gonna be maybe not 365. You might have holidays or whatever. Like I don't know how the actual structure of like buying and selling mechanics on stocks works. But there's gonna be a day where you're gonna be able to buy and sell all day, every day. And I mean, I think it's cool. I mean, we don't know what kind of volatility and stuff that's going to bring in the market and all kinds of stuff like that. But Robinhood starts all this stuff, man, and all these other brokerages are like you either adapt like Robinhood did, or you lose some customers. So
Exactly.
I appreciate it. Okay, so and then you mentioned that your daughters are into it. So you have your daughters into it. Are your daughters yet showing interest in investing, or are you just doing this on their behalf?
I do it on their behalf, but I also talk to them all the time. So I always say, I might come by and say, what companies do you own? Or I talk to them about the aspects of, I go through my different charts and I say, hey, this is what you have in your custodial account now. This is what happens if it compounds at 15% for the next 35 years. And I say, you'll be this age 35 years from now. So if it compounds at this amount for 15 years, I also do 18%. And I'm able to show, like, if you add $100 a month, how much it'll grow into. You add $200 a month. And just by continuing to stay consistent and just building, I said, you're going to reach financial things at 35, 40 years old that most people don't ever get to until they 70 or 80.
Mm-hmm.
And plus, because of inflation is never going to stop.
Mm-hmm.
It's going to continue. Like 5%, 4 or 5% inflation means everything doubles in price every 15 years. So if your money is not doubling at a rate faster than that,
yep.
then even if like now, you say, 30 years I'm gonna be a millionaire. Where if everything doubles every 15 years, then that means that the prices have doubled almost twice. So that means that your portfolio, that $1 million, is half twice.
Mm-hmm.
So for 15 years from now, $1 million has $500,000 worth of spending power, and then 15 years after that is $250,000 worth of spending power. So your money has to compound at a rate that's higher than inflation, number one. But also you want to look at what's going to get you the best compounding rate for a long period of time. And that's what I look at. So my objective is to constantly talk to them, to educate them. And eventually, I know, like, the age of majority in Ohio is 21. Eventually the account becomes theirs. So they will have an opportunity to continue to add to their account and then reach their financial freedom way, way, way earlier than most people will.
Yeah, so. I'm wondering, so we have the 5-month-old now, and I have him a custodial account. And right now, I think he's in QQQM and VOO. So just stuff that I don't have to manage. I'm just like, okay, let's get his money in there. What the wife and I plan to do is, like, any money that he gets for Christmas, his birthday, Easter, whatever money, or whatever reason you give kids money, that's all going in his account. And then when we get the tax rebates, because we don't know what that's like yet. He was born on January 5th, so we didn't get the due for 2022. So whatever we get extra because we have a kid now, we're going to figure out what that is, and we're going to take that money out of our tax return, and it's going right in his account. And we're going to do that for 18 years. So if it's $1,000, $1,500, whatever it is, that's going right into his account. We're going to invest. My plan, again, this is all, new parent saying this, but my plan is keep doing that until he hits a certain age where he's old enough to, like, pay attention a little bit. And then I can talk to him about it, and he'll, obviously see the YouTube channel and all kinds of stuff. Hopefully he shows some kind of interest in it. And then I can get to a point where I'm like, okay, like, what do you think? Like, what do you think? What's a company? What is everybody talking about at school? Like, what's a company that you might want to buy? And then we'll talk about it and figure out if it's a good buy or not a good buy and why, and we'll understand that. And then hopefully, by the time he's 18 and he gets the account, he'll have an interest in it. To at least keep it going, if not, like, expand on it. Like, if he just wants to keep doing those like I said, even if it's ETFs and you don't show any interest, just keep doing that. Because investing in, I don't want to say this quite literally, but it's almost like investing in anything is better than not investing at all.
Yeah, that's true.
So,
that's
I
true.
mean, there's obviously bad investments and stuff like that, but even with a bad investment, you learn your lesson. And as long as you apply those lessons, that can be, fruitful for other things in life too. So that's really important. But yeah, I wonder about that with, like, other people that have their young kids investing, if they're, like, showing an interest or if they're just doing this on their behalf or how that works. So
yeah, so the objective is to try and educate as much as possible early on.
mm-hmm.
So they're the same way too. I invest strictly in individual companies.
Mm-hmm.
I believe that's just my philosophy is developed that way. It started in 2016, where I went, I think, about 85% into individual companies. Then I noticed the growth rate compared to, in my Roth compared to what was the companies where I still had funds. And then 2018, it was a pullback in 2018 around October, November, December 2018. That's when I sold out the rest of my index fund. I got completely out of mutual funds in 2016, but I still had a couple of index funds, and then I got out of those in 2018. And so the last 5 years, I've been 100% individual companies only. So same way for them. I invest and buy different shares of companies, and I look for the best companies that they can own. And it's really, I always say, people think it's like so difficult to manage, but I really don't have to manage anything. Like I said before, my money that's invested in Apple, Tim Cook manages that.
Mm-hmm.
Andy Jassy runs Amazon. Michael Meebach runs MasterCard. Marvin Ellison runs Lowe's. So all I gotta do is I don't have to sit and like, oh my God, the stock's going down. Let me make some action. But all those companies I own all of those for 6 years or more, and by just owning the companies and continuing to add to them over time, I haven't had to do anything. They just continue to grow. You get the occasional bumps like last year or for Amazon the last couple of years, but it's not about what one company does because it's like a football team. You can have a player that has a bad game or two players that have a bad game, but it's about how everything works in aggregate. So like if Amazon has a bad year or Mastercard has a bad year, you know what? Apple might have a good year.
Mm-hmm.
Or so they all working together, and it's about how they work together over time. And if you have good companies, even if you have a couple of bad companies involved. So I went through also. I started creating my YouTube channel. I did one in a video called 25,000 to 7 million, just showing that 25,000 invested. I think it was over a 35-year period that was invested and just left alone. It was I chose 15 different companies to put in there. 5 of the companies I chose were quote unquote, they were below average. They were single digit returns over a 35-year period. They included Ford, they included GE, AT&T. It's a couple of below average companies.
Mm-hmm.
And even with those below average companies, it was like 2 or 3 at the top that really just drove the overall performance over a 35-year period, where it's still compounding at a high rate for a long period of time. If you can, after a while, you can differentiate. If you really take the time to look at what makes a good company, and I know you have your criteria.
Mm-hmm.
If you just look at it and keep it simple,
Mm-hmm.
investing is made so difficult that we got to sit here and break out calculators and do all these complicated things. If you have to do all that, then maybe it's actually too much. I heard Warren Buffett said one time, he's like, I'm not looking for needles in the haystack. I'm looking for haystacks. So I wrote the company, and for me, my haystack, I think, well, never mind. I know I'll save it for later.
Yeah, it's that's very true. Like I get a lot of slack. One for my age, like being into the investing space and being young. I know a lot of people that click on my channel. They see me that I'm young, and they're like, "This guy doesn't know anything," and I'm like, "That like, at least give me a chance. Like, let me talk." Like I've learned a lot. Like I'm a why person and a rabbit hole person. Like I just constantly like I never stop at the surface. Like there's always more. And that's helped me a lot in like fitness and finance. Like those are my 2 big things. I've just learned so much about all kinds of stuff that like I feel like I have more experience than my 3.5 years worth would say. And I know a lot of people that I've whether it's these interviews or just people that I talk to, they're like, hey, like you might not have started exactly when you wanted, because I started pretty much at like 25. And everybody always wishes they started sooner, right? Like if I could have started at 18 or whatever, but like I didn't know. I don't know anything about investing or anything like that. And you start when you start, and then you just focus from there. You can't change the past, so you just learn as much as you can, as quickly as you can, and understand. Mistakes are going to be made. As long as you're understanding and using those lessons to better yourself, you'll be all right. Like you're already doing better than most just by getting started. So.
Exactly, and you learn more too from reading.
Mm-hmm.
Like for instance, I learned from making mistakes in investing, but I learned more from continuing to read and continuing to learn. The mistakes became more obvious the more I read and the more I learned. So I look back, and that's one of the reasons where what Philip Fisher talked about in his book Common Stocks and Uncommon Profits. And he talked about the reasons to sell a stock, and he said the first one is obvious when you make a mistake. So you go back and you look at this mistake and you say, okay, what was the mistake that I made? And you analyze it and you say, okay, this is the mistake I made. I jumped in this stock. Somebody mentioned it and I just bought it because they mentioned it. I didn't do any research. And then from there, you analyze the mistake. And then the objective is to not make the same mistake going forward. That shows growth. That shows that you're learning. But if you just sell one stock and then you just go pick another one that somebody else did, or you jump on the momentum train, or you just follow the crowd, you doing these things, you might have differences with the performance of your portfolio, but does that mean you're actually learning? Because
Yeah.
it's not about what happens over a year or 2 years. It's about how it does over a 20 or 30 or 40-year period. And if you have like 2020 fooled a lot of people,
Yep.
it made people think that investing was like so
Oh
easy.
yeah, you got the everybody makes money, right? Like that's how that
Exactly,
works. Yeah.
exactly. It's like no matter what, when the world was shut down, no matter what people bought, it went up.
Hmm.
Especially when it went down in March, no matter what people bought, it went up. So people became like, oh, investing is easy.
Hmm.
Investing is easy. So people jumped on the AMC train, the GameStop
Yep.
train. So they jumped on these because everything was going up. So they was like, everybody else getting rich. Let me do this.
Hmm.
So me, the company I bought the same companies I had owned, prior to 2020, and I still like I didn't have to sell. I didn't have to sell. I only had a couple of new companies. I didn't have to sell Apple, because I was fearing it's going to go down. Like people had to get out of GameStop, get out of AMC, and
Hmm.
get out of Bed Bath and Beyond and Peloton and Beyond Meat. All these companies had to get out of them because they weren't like the companies weren't stable. They
Hmm.
weren't growing companies. They were growing revenue and growing cash flow and growing earnings. They were just companies where the stock price was shooting up. So you have to differentiate between was a stock or a hot stock or was a good company, because there's a difference between a hot stock and a good company. So
Yep.
that's what you're looking for, the best companies to own.
Yeah.
And that's how I look at it. My my philosophy is I don't even view it as I'm investing in the stock market, because I know that the companies or the shares are bought on the New York Stock Exchange. But I use the analogy, if someone is buying a rental property, I never hear them say I'm investing in the housing market. They always say I'm buying a property.
Hmm.
It's the same way when I'm buying a fractional ownership in a business. I am buying a business that I believe has tremendous long-term potential, that I can buy, that I can own, not just for me, but that I can pass down to my children and grandchildren. And if you're right on two or three of those businesses in your lifetime, then your entire family tree can be changed.
Hmm.
There's a couple of them. You just get them and own them and just let them compound,
Yeah.
and you'd be good to go.
Yeah, yeah, I completely agree with all that. It's super important to get started. It doesn't need to be as complicated as everybody makes it seem, and it's also um, if the lack of lesson applying, like you have to like you said before about like understanding this company is bad and why the company is bad. Like was it, and that's the other thing. I even said that wrong. A lot of times they're like, "Oh, this company lost me money. This company stinks." Like, okay, that's not the reason. That's not the lesson. The lesson is like, why did you buy the company in the first place? What made you lose money? Like all these things. And if you can take that and apply it to the next purchase, then you can already be a better investor. And maybe that one doesn't work out. Why didn't it work out? And that's what I mean about me digging all these holes and trying to figure out like, okay, here's the surface, but what's under? Like, what am I missing? Like, what can I learn from this? So that's super important. Okay, so next one. We all have done things that we're not proud of, and we like to. So we're not proud of, and then things that we like to tell everybody that we were right on. So what's your biggest selling regret and your biggest buying brag?
Selling regret. I don't know if I have per se a selling regret, because the companies that I've bought, I've held on to. Like the ones that I've actually bought, I held on to. So some of the ones that I've sold to put money into the companies that I really love.
Mm-hmm.
So I haven't really.
Did any of those ones that you sold turn into maybe more than you've made with the one you put it into, or no?
No, because the ones I sold initially, when I bought names. I bought the Cokes. What I bought GE, because I live in Cincinnati. So GE, I just bought names: Coca
Yeah.
Cola, GE. I bought. I had Honeywell. It's still a good company, but it didn't fit what I wanted.
Yeah.
Um, AT&T, which is one that I'm glad I got rid of a long time ago. I bought that one because everybody mentioned it because of the dividend yield and,
Yeah.
and all that
Yeah.
stuff.
You
So
don't like 7% yields? What's wrong with you? Yeah.
but it's not the 7% yield. It is the growth rate.
Yeah.
So
Or lack
example,
thereof.
yeah, I like that. So example is, if like when AT&T had a 7% yield, I remember it because the dividend growth rate was 2% a year. So 7% yield, 2% a year. That means rule of 72. That means it's gonna take if you're assuming you're not reinvesting the dividends, it's going to take 36 years for your income to double at 2% growth rate. So I looked at Home Depot, which was 2% starting yield, but was growing its dividend at 18% a year. So I went through and I did the math. I said, if you invest $10,000 in each one of these companies, AT&T, you're going to start off at $700 a year. Home Depot, you're going to start off at $200 a year. So right here, you have a difference in the starting rate, and you have so AT&T looks like a better one from a dividend standpoint. But if you look at it over, let's say, a 20-year period, well, I said 30 just to make the math easy because of the fact that Home Depot or AT&T is growing at 2%. It takes 36 years for that money to double. 18% means that the income would double every 4 years. That means over a 20-year period, your income would double 5 times. So even though you started at $200, so it doubles from 200 to 400, then 400 to 800, 800 to 1600, 16 to 32, and then 3200 to 6400. So 20 years later, you're receiving $6,400 a year in income from the Home Depot, the company that grows its dividend at 18% a year. Whereas you start out with $700, it hadn't even doubled to 1,400 yet.
Mm-hmm.
It takes 36 years. So if you can have the difficult thing for a lot of people to do is to look at other people saying, I got X amount of income. They have a smaller portfolio in value, but their income is greater. That's where you have to critically think for yourself and say that, I'm not chasing income. My income is coming. Like you're here, I'm here, but it's like this.
Mm-hmm.
Mine's just growing and growing and growing. So eventually it surpasses what you would have got from high yield companies.
Yeah. Well,
And
and you see a lot of people in our group do that where they're 19 years old or something like that. And I mean, kudos to them for starting so young. And at a certain point, like I really hope that these interviews, whether me and you or other dividend people that are talking, the hope is that people can learn the lessons that we learned and they don't have to learn them themselves. The issue is the lessons best learned are the ones you learned yourself. Like at the end of the day, like it takes you making a decision with whatever you have in your head and losing money in that decision to understand like, oh, okay, this is what they were talking about. It's like just like when you're growing up and your parents tell you something, never connects until you're older and you're like, that's what they were talking about. Like
exactly.
You have to learn that lesson yourself. So you see like 19-year-olds in the group and I've seen portfolios at like 22% yield. And I'm just like, what are you like? You're sacrificing so much long-term growth just to make it look like know what you're doing when you do your little recaps on YouTube and you're like, oh, here's my crazy small portfolio with this crazy dividend that you're getting back. And I'm just like, first of all, not sustainable. And second of all, you don't need that money for decades. And you're sacrificing long-term capital appreciation and dividend appreciation just to make it look like you know what you're talking about today. And I just try to harp on that. But like I said, sometimes you just got to learn your own lessons. So
Exactly.
yeah.
Oh, and then let me see if I can find it. Oh, so now can you see that?
Broadcom?
Yeah.
Yep.
So if I guess if is any brag, if you will, I don't necessarily brag, but in 2020, that was when I found Broadcom. So in January of 2020, I was watching CNBC and I saw that Broadcom had just signed a $15 billion multi-year deal with Apple, or up to $15 billion. And the price at that point was $3.13 or something a share. And January 28th of that year is when I first bought Broadcom. So I bought it, and then of course COVID hit in February, around February 24th, give or take, February 20th, and then all the stock prices started going down. But I had bought Broadcom, and when I looked at it, I was like, this company is like selling for super cheap. I said a minimum of $400 is what this company is worth at that particular point in time. So, but the stock price started going down. It was going down, went down in February, and it went down tremendously in March. You can see here, 1, 2, 3. I bought it 5 times in March of 2020, and this is 24 shares that I bought. My lowest one was right here, 11 shares at $175 a share. And so the total invested in 2020 was 49, not in 2020, but in March was 49.37. Broadcom today is $822.15 a share. So these same 24 shares are worth almost $20,000 today. So that's a gain of 300% when you look at it from a standpoint of that. So 300% growth, and for company that I've well, it's been 3 years now that I've owned for 3 years, and I bought Broadcom a lot in 2020. So, and I own quite a few shares of Broadcom. It's become my number one position, and I just love the whole aspect of Broadcom. And oh, this is what I talked about earlier about the growth rate. So this is you can see this too.
Yep, the charts.
Yeah,
Yeah,
yeah.
yeah.
So this is my rate of return from so almost 7 years from. So Charles Schwab redid their website. So as far as you can go back is 2016. So from 2016 to 2 days ago. Yeah, yesterday actually. So you can see my rate of return. This is I call this financial freedom. This is my brokerage account. So 18% compared to 12.8 for the index. And then my Roth is 18.78% compared to the same 12.8% for the index. So I look at that. You can see the difference in 2022 when everything went down. But that didn't concern me because when you own good businesses, you just own the business. You just let them compound. They're going to go through some gyrations and stuff for the market. And what happens is when you own good businesses, over the longer you own them, there becomes a wider separation from every research I've done. There becomes a wider separation between a select few of really good businesses and the index.
Mm-hmm.
So you can see here the difference here, 18.78. And this actually was before 2022. This is a 5-year period. So my brokerage account was 25% rate of return over a 5-year period. And my Roth was 28%. So one of the things that I started doing as I noticed the growth that was going on is I had money in a SEP IRA,
Mm-hmm.
and I said initially I have to start converting this over to a Roth because it is growing at such a tremendous rate. I have to get this money out of my SEP and into a Roth. So I've been doing that for the last 5 years now, where I convert a little bit each year. So every year it converts. The money is counted as taxable income that year. But, I'm 49, so another 11, 12 years, then that money that's in my Roth, guess what? It's all tax-free, that and the income. Now, if I'm growing my Roth as it is now, minus 2022 at 18% a year, that means that my money is doubling every 4 years, less than 4 years because it's more than 18%. And so I can look at the value of my Roth and I say, okay, 12 years from now, or 16 years from now, or 20 years from now, at 18% a year, I know that my money is going to double every 4 years. So I can look at, okay, this is the amount that I could potentially end up with in 15 years. It's all tax free just by owning good companies that compound at a high rate for a long period of time, and then just letting them compound. So, and that's what I always look for. And one example I have is Lowe's. Let me pull it up here. Okay, there it is. So Lowe's. All right. So Lowe's in July of 2016. This is one of the first companies I sold when I got rid of my mutual fund. So I bought 156 shares at $79 a share, and you see the principal was 12,400. See, there's that commission they had back then, $8.95. Glad those are going. So $8.95%. Now the dividend income that I received from that time, my first dividend check was like $54. So I went back and then I pretty much, like, oh, there it is. So dating back to 2018, I went through and I copied from the brokerage account, just to show the actual growth of just reinvesting the dividends. Not really add. I've only added. Now this Lowe's right here is in my Roth. So I've only added one time, and that was in 2022 where I bought 8 shares at 235, so $1,900. But you can see this right here is the amount that Lowe's increased its dividend every single year. So 17% in 2018, 14%, 9%, and then there was 30% years in a row where Lowe's increased its dividend by 33%. So it went from the initial dividend payment of $54 in 2016 So now it's up to 190. They just increased their dividend by 5%. So now it's over $200 per quarter. So roughly it's $800 per year now in dividends. That's just from just reinvesting the money back into Lowe's. Just when they pay the dividend, reinvest it, buy new shares. Of course, the dividends are going to start compounding. So you get this compounding component where in 2018 it's $66. Now it's $190 per quarter. And you can see because of the growth here, it pretty much doubled from 2020 to 2022, really. And that the 8 shares had a little bit to do with it. So now if I go through this and I say, okay, I'm getting $800 a year, and I try to go through and do math, I'll look at the Lowe's dividend growth rate. So the 5-year dividend growth rate is roughly 20%. The 10-year dividend growth rate is 20%. And this is on Seeking Alpha, of course. And you can see the compound annual growth rate to 2022. So dating all the way back, you're looking at 18%, 20%. So you're looking at a potential of continuing to grow it, the dividends at 18 to 20% a year. So I know that 18%, my income is going to double every 4 years. So 49, I got 59 and a half, so roughly around 12 years before I have access to my Roth. So at $800 a year, 12 years, it'll double 3 times. So it'll double from 800 to 1600, and 600 to 3200, and then 32 to 64. And then if I wait another 4 years, it goes from 64 to 12,800. And then by year 20, you're looking at $25,000 a year in income just from doing absolutely nothing but reinvesting the dividend and letting Marvin Ellison run the company and me just being a shareholder and owning the company. Mm-hmm. And that's one of the best things you can do is identify. And Lowe's is not even like the best. And that $12,000 too in capital appreciation terms is now worth $38,000.
Mm-hmm. Yeah.
So just I get the dividend growth, I get the capital appreciation, and Lowe's is not even like the best, like the fastest growing company I own. Mm-hmm. But it just shows the show. It's doing its part, along with Home Depot and some of the other ones as well, MasterCard, etc. So
yeah, well, that's one of the cool things about the dividend world in general is just like you have so I try to explain this when you have your stocks and say you have 100 shares of companies in your portfolio. When you see the stock market goes red and it goes down 5%, the money that you had in there is now 5% less valuable, but the money that you're going to use to buy is now getting a 5% discount. And then same thing vice versa. The market's up 5%. The money that you had in there is now 5% more valuable, but everything that you're buying is now 5% more expensive. And the cool thing about dividends, so that's a way you can frame it where there's always something positive to think about with that, whether either your old money became more valuable or your new money is buying you stuff at a cheaper rate. So those are the two ways. And the beauty with dividends is no matter what happens, you're still getting paid. They're paying you regardless, when that's great.
Exactly. And then you look at I'm always on Portfolio Visualizer a lot.
Yeah.
So I'm looking at different. So I do this to look at the long-term compounded potential. So I took 2 companies, 20,000. So that's 10,000 invested in each way back in I think 1986, January 1986. So Baldwin Hill, that $20,000 would have compounded at 18%. So I look at one of the things I talked about earlier about your CAGR. Mm-hmm. People don't realize the difference over a long period of time in just how much 2 or 3% can make. And when you're giving away 2 or 3% in mutual fund fees, you're getting so much less than you could over a long period of time. Mm-hmm. So these right here come over 18% over a 36, 37-year period. $20,000 grows into $10 million. But also you look at the income component where you have this gradual growth of income where a $20,000 investment is now paying you $151,000. Mm-hmm. So, and I look at 2 other companies. I also put in Home Depot and Johnson & Johnson. So just to kind of show the difference in 18% versus 20. So just 2% more is 18% or $18 million. Now, people will say, well, it's easy to backtest and pick out these different companies. I said, okay, let's say it wasn't just two companies. It was actually 15 companies. And you were such a bad investor that the other 13 companies you bought all went out of business the next day. It still wouldn't have affected the growth of these particular companies. So me owning Lowe's, that has no effect on what Apple does in my portfolio. Whereas a fund, the fund is, if you buy a fund, it's generated by everything that they own in the portfolio. So you can continue to get good growth by owning good companies. That's why I believe if you just own good companies, just own them, just let them compound, and then your money begins to compound at a high rate for a long, long, long period of time.
Okay, so you're speaking of your buying brag with Lowe's and with Mastercard and with Broadcom. Do you have any dividend milestones or achievements that you want to share, and what role do those play in keeping you motivated?
Well, my motivation is financial freedom.
Mm-hmm.
So my milestone, I guess, is I've surpassed $1,000 per month in dividends. So my objective, if I was strictly focused on income, then my income would be higher.
Yeah, exactly.
Which means because I own a pretty good amount of Amazon and also Nvidia, which is in my top five. Both of those are in my top five, and they don't really pay dividends. So the aspects of those aren't. Amazon doesn't pay a dividend at all. I heard what you said about Nvidia's dividends.
It's gross. It's disrespectful, is what it is.
It's minuscule, but I'm fine with them putting money back into the company that
Yeah.
grows at such a rate where my money can
Well, just
grow.
keep your 4 cents. Like, what do we need? Like, just keep that 4 cents. Like, we don't need it.
I think when they started it back in back in the day, typically like when you start it, you don't stop. I mean, you don't take it away.
Yeah.
You just keep it there, and then they just hadn't increased it since December of 2018.
Ugh.
So, and eventually, I look at potentially when Amazon stops conquering the world, putting all that money in capital expenditures, and eventually they might start paying a dividend down the road. Same with Google. Who knows?
Yeah.
But
Tesla.
Tesla. So those are the ones that I don't own. That I own that don't pay dividends.
Yeah.
I was interested in, because I used to always think the same thing with the dividends, because the objective is you don't want to sell your assets, and you want to be able to have money to grow. And I was thinking like, oh, if you have the companies that don't pay dividends, then you have to sell off your assets. You keep selling them down and down and down until eventually they might be gone. But yesterday I was watching CNBC, and they talked about Warren Buffett had just made his contributions to his 5 charities. He started in 2006, and each year he gives away 5%. He converts the Berkshire A shares to Berkshire B shares, and he gives them to those 5 different charities. So in 2006, when he first started, he had 475,000 A shares, and his net worth was about $43 billion. Since that time, with all the shares over that 17 years, he's given away over $50 billion. So he started out with a net worth of $43 billion. He's given away $50 billion. So he has about half the shares left. So 218,000 shares when he started with 475,000. But now his net worth is $112 billion. So even though he's given away $50 billion because of Berkshire Hathaway continuing to grow, his value has continued to grow, even though the shares, he has less shares. And Berkshire Hathaway hasn't been any type of superstar performer. It's been average since I think it averaged maybe 10% since 2006. But even with the companies, but he gives away about 5% a year. So even with my non-dividend paying company, so the objective is, of course, to be able to have income covered through dividends. But if I did, like people talk about 4%, 5% of a company that's growing at 20% on average per year, then you're still going to come out with more money in the long run, even though you're selling off here and there, which I don't really want to do. But I will continue to own those shares as well.
Yeah, when that's the beauty about the dividend investing is that you don't have to sell, especially. So I know Chad talks about a lot about yield on cost, because you get that yield on cost up there with those companies that you've held for such a long time that like eventually your Apple and Microsofts that don't pay much of a dividend yield today, 30 years from now, they might be paying enough of a yield to you because you've held so long that you never need to sell. One, they're income producing assets. but two, your yield on cost is so high because you held for so long. And then the other thing with some of those other companies is you just because you're a dividend investor doesn't mean that you can't be a growth investor. And for some reason, people want to separate those all the time. You could be a dividend growth investor, which is what we do in our group. But in the case that you did want to separate those and buy those companies that don't pay dividends, the idea is that you can put so much money into those companies will turn into 10, 20, 30x more than what you put in. And then you do have the option, if you wanted to get rid of that company, to sell it and then put it in an income producing asset later on. And it's just significantly more than you could have ever saved, or even if you would have started in that company, like the growth that you got just in capital appreciation from those companies is just significant. I've talked about that in a bunch of my videos before. The yield too soon video, I thought, was very well thought, where it's just like, hey, it's not necessarily a right or wrong decision. It's just an opportunity cost. Here's your opportunity cost by going for these companies that are producing income maybe before you need to. And if you were to just focus on these other companies, your Costco's, your Tractor Supply companies, your Lowe's, your Home Depots, all those companies that are growing at significant rates would actually be better for you in the long run, both in terms of income and capital appreciation. So like that's just crazy to think about with that. So I do want to know, because my criteria, the outperforming of the S&P 500, the 5 or more dividend streak, and then a dividend growth rate of 10% or more. What is your criteria that you use to pick your stocks?
The outperformance is key.
Mm-hmm.
I don't buy any company especially over a 10-year period. If a company has not, when you in this, we had this bull market from 2008 all the way through 2021. If you have a company that did not outperform the index during that time period, then what makes you think that during this turmoil now, all of a sudden it's going to become a stellar performer? So if I look at the long term, that's one of the things I look at. I use the portfolio visualizer and dividend channel. So I look at the company. I was like, how has this company performed in the past over the last 10 years? And I know the saying is past performance is no guarantee of future results. And I mean, that's true, but I think the truth lies more so in the word guarantee than it does when you actually look at it. I look at it like a NFL general manager. They just had the NFL draft not too long ago, and you look at a player, like an NFL player, or an NFL general manager is looking at drafting a player to go into his team. So he's going to look at the investing. You look at quantitative and qualitative. So you want to look at the quantitative aspect of it. So you look at the numbers. So the NFL general manager might look at what's his 40 time, what's his bench press, how fast he does this, and then from that standpoint, from a business standpoint, you're looking at, okay, what is the dividend growth rate? What is the earnings growth rate? What is the return on equity? What is the return on capital? What is the net margin? What's the profit margin? So you're looking at these numbers. And then you got the qualitative aspects where you're looking at the quality of the business. Like an NFL general manager, they're drafting a quarterback. They want to know how fast the quarterback processes information. What's his leadership skills like? Mm-hmm. Things you can't necessarily pick up on, by just looking at the numbers. Mm-hmm. But you can look at a company like Apple and say they have an ecosystem. And once you get in that ecosystem, you're pretty much in that. Like it's hard. Like I wouldn't go back from an iPhone to a different one because I got the iPhone, the iPad, I got the Mac. So I'm in that ecosystem. Apple TV, so I'm in that ecosystem. Most people get in.
Warren Buffett talked about that. $10,000 to get people to stop using their iPhone, and he said they wouldn't take it.
Exactly. Yeah. So you look at that aspect of it. So the performance, how companies perform over time, and then you can have those companies that, like a player might draft a NFL general manager might draft a player that turns out to be a quote unquote bust. So the difference is for us, we get the opportunity to draft, however many players you draft. We only have first round draft pick. That's how I look at it. We only have first round draft pick.
Yeah, we pick first, second, and third.
Exactly. And so you look at it like, okay, if a team, if you only looked at it, Warren Buffett talked about if you treat it like a punch card, where all you get is 20 punches, and if you take your time and say any investment decision, once you reach 20, you can never make another investment decision the rest of your life other than adding to what you already have. You would take a long time and really look at the companies and really focus on all the aspects of the quality of the companies. So that's one of the things I look at. So that also, like I talked about, return on equity, I look at the profit margin, because you want to have a company that's profitable. So I look at the profit margin, return on equity. There are varying numbers, but I think pretty much most of the companies I have a return on equity of greater than 15%. Because I heard him say one time that you never get rich having a company that has a return on equity of 5%.
Mm-hmm.
So return on equity is good because that's what the business is making on the shareholders' equity. So if I'm a shareholder, if I have my money in here, the company should be making some return on my money that I have invested too. So return on invested capital, return on equity. Also, because there are certain ratios I look at, but they can differ, across, a PE ratio for one company in one industry can be different from another industry. MasterCard, since I've owned it's very rare that the PE ratio has been less than 30. So it's always been around 30. And same with Costco. Costco has always had high. Everybody's been saying Costco is expensive for years. I've had it for like 5 or 6 years. It's been expensive for years. Then so I haven't been adding anymore. But all it does is just keep growing.
Mm-hmm. Yeah.
They keep on opening new warehouses. They keep on doing that. So I look at, is the company growing? Is it growing its earnings? Is it growing its revenue? Is it growing its cash flow? Has it performed well in the past? Because most companies are going to perform in a manner that's very consistent. Like I said, 10 of the companies that I've owned for 5 years or longer. And it is even coming out of 2022, those companies have performed in a manner that's very consistent with how they performed the 5 or 10 or 15 or 20 years prior. Not necessarily the exact numbers, but very, very consistent. They've all continued to perform at a level higher than the index. So, and if it's a good company, there's run because the best companies, people always say, the market is a return 10% a year for. Anytime you look at like the companies, what they show like the companies that companies are invested in the index, they usually show the top companies. Those companies don't grow at 10%. It is the other portion of the portfolio, the AT&Ts, the Fords, and other companies that
it's the
bring
average
down
of the whole thing.
Yeah, it's an average. It's an average because I think mean like the average. I think the average NBA team scored like 114 points a game or something like that. If you take that out and you extrapolate and say it's 15 players per team, so that means that the average NBA player scores about 7%, 7 to 8 points a game. But that's not what LeBron does.
Yeah.
That's not what Steph does.
Yeah.
So that's why I want LeBron. I want Steph. I want Tom Brady. So that's why I get Apple. That's why I have Broadcom. That's why I have these. Those are the ones that I want to own. So I don't want to necessarily buy companies per se that's going to give me the average. I mean, that's fine if you're afraid or you're nervous about your shares dropping or something like that. But I don't have that same concern, that same fear of owning individual companies. Like all of a sudden, one company. Because last year I had Nvidia, Amazon, and Innovative Industrial IPR. All three of those went down 50 to 60% last year. So. But my portfolio, you saw the performance, it still continues to grow and perform at a level higher than the index. Of course, Amazon and Nvidia came back. IPR still make you want to punch it to the wall. At least it's paying me. At least it's paying me, but I still own it. Because there are certain criteria that I like about the company. But we'll see how it goes.
Well, and that's the other thing too, is that's why I always say you do need, like, you can make your investment criteria as complicated or as simple as you would like, as you understand. The big thing is writing down or understanding why you bought the companies in the first place. Because when you bought Broadcom and Broadcom was at this point and then it goes down 5%, down 5%, down 5%, you didn't panic because you identified it as a good company. And I give this analogy all the time. If I'm going to go to Walmart and I'm going to buy a flat screen TV and it's $600, and then I'm like, you know what? I forgot this, or I don't have the right car to get that TV. Like, it's bigger than I thought, whatever. I go back to the house. I come back the next day. That same TV's on sale for $400. I'm not like, wait a minute, what's wrong with this TV? I'm like, heck yeah, I'm getting the same TV for cheaper. So it's the same thing with your stocks. If you identify Broadcom, Lowe's, Home Depot, Costco, Apple, Microsoft, if you identify these as good companies, you don't care about the daily fluctuations in prices because you're just getting it cheaper. Like I said, you can evaluate it of the money that you had in there is now worth less, but now the money that you're going to put in there is now stretching further, or vice versa. The money that, if it goes up, the money that was in there is now worth more, but now the money that you were going to put in there doesn't stretch quite as far. So it's always like, just focus on the positive of whatever situation's happening. You can't control the situation, so just focus on the positive of it, understand why you bought your companies, and just move on.
Exactly. It was the same way in 2018 when I first bought AbbVie. I bought AbbVie, and the price had gone to I think $125 a share. And I was same thing. I was watching CNBC, and they started talking about, well, in 5 years, Humira's going to lose his patent and this and that. And it was like the company was still growing. So I looked at the numbers. The company was still growing. I was like, that's 5 years from now. But the stock price kept going down. And I first bought it in 2018. I think it was 99. It was one of those companies where I was getting rid of the rest of my mutual funds. So I bought it. It was $99 a share. 1 year later, the price was 39% less. So I could have panicked and sold out, but I looked at the company. I spent a lot of time looking at it, and I evaluated it. I was like, this company I can make a decision in 5 years, because I knew it's going to be at least another 5 years of growth because of the trajectory that it was on. Mm-hmm. So I looked at the company, and I said the price kept going down. So I bought a little bit, and I bought more, and I bought more. And then they announced in 2019 that they were buying Allergan for $63 billion, and the price dropped in 15% in a day. So it went down, and then between $70 to $80, I was like, let me try and buy as much as I can while I can. So now it went all the way up to like 160. I think it's like 130 today. But at the same time, like, it could be to the point now because of the patent expiring, that they can be the next couple of years, because they're not supposed to be, or not projected to return to growth phase until about 2025. But I own enough shares where if each time the dividends are reinvested, I get about four or five shares. So I own enough shares of AbbVie because I've owned it for a number of years where it pays pretty well. So even if the price is stagnant for the next year or two, or even if it goes down, it benefits me more on the dividend aspect of it, because as I'm reinvesting the dividends, I get to buy more shares, which in turn increases the next dividend payment, or I get to buy more shares at a cheaper rate. So I don't really get caught up in the stock price fluctuations and what happens from that standpoint. And I go from a standpoint of, it takes me a long time now, especially after 2020, once I found Broadcom and NVIDIA, and I had a Tesla in 2022. So I added 0 companies. I own 15, so I added 0 companies in 2021. I added Tesla. I had 1 company in 2022, and I added 0 new companies this year. And I don't really plan on it, because if you find 2 or 3 really, really, really good companies, and you just believe in these companies, and you see the growth in them, and you just continue to add to them over time, you can dollar cost average into these companies. And sometimes you buy here, but over the course of time, because you're buying them consistently, you're going to buy here, you're going to buy there. But if it's a really, really good growing company, your money is going to compound at such a high rate that you're going to benefit so tremendously in the long term. So the key is just being consistent, looking for the good companies, and don't try to look for every doggone company in the world. You can't. I see some people who have, like, to me, they have way more companies. I got up to 25, and I was like, man, this is too many. Then the number you have, all of them aren't even really attractive. They don't even really grow to the point. If you find the ones that really grow and you put more money into them, money compounds faster from a higher dollar amount. So if I had $200,000, I would rather have 10 companies with $20,000 than to have 100 companies with $2,000 each.
Yep.
Because I know that the companies, if they're chosen correctly, by them having 20,000, or they're going to compound faster because of the dollar amount. If you get a 10% return, $20,000 is different than a 10% return on 2,000. So and that compounding effect tends to escalate even faster.
Yeah, I don't know if I've talked about this on the channel or not, but when I first started my journey, I was digging into so many different things, and I had like what was called a T score, because my name's Troy. I was like, okay, this is the T score, and this is how it ranks, and all kinds of stuff. And it was literally like, here's a group of stocks that are all in the same sector. Here's a certain metric. Here's where it ranks amongst its peers. Like, it was all like informative stuff, but like, I didn't know, like, I told the story on one of the other interviews, like, I was backwards calculating dividend yield. I was like, okay, I don't know what dividend yield means, but if I put $100 into this company, it's going to pay me this many cents. I was like, okay. And now I know all that stuff. And like, I think it was 37 or 39 different companies with 3 ETFs is what I held. And I
Mm-hmm.
came across the exact realization that you just said is like, I was getting a bunch of dividend. I was getting paid, it felt like every day. But it was
Yeah.
one of those things where I was stretched so thin that I wasn't making progress on anything. Because
Mm-hmm.
there's 37 companies at the time I was, I don't know, putting $100, $200 a week in. And it was just like you place that evenly to keep everything diversified and balanced. And I was
Mm-hmm.
putting $5 in or something, whatever that math works out to, each time, each week in each of these companies. I was like, I'm never gonna get there. Like this is gonna take forever. So like
Exactly.
it was what, and I pulled back and I was like, okay, what's a good number? Like what's a good number that I can manage, that I feel comfortable with? And like you said, you don't need to have all the stocks. You don't need to have all the winners. You just need to have a winner or two, and you'll be just fine. So like if you put, you could have 10 winners and you could have little bits in each of them, or you could have one winner and you could have all your money in that one winner. Is it more or less? Like either way, you're up a lot of money, probably most likely. So, okay, excuse me. So the next thing is when you're selecting your stocks, how do you um, keep them diversified, like throughout the sectors and industries, and then like how do you help manage your risk? Like how do you diversify your portfolio?
I really don't put as much emphasis on diversification as someone talked about it in common stocks and uncommon profits. Philip Fisher talked about it. He said, "Don't overstress diversification," and because you can have people can in the sense of diversification, people can diversify to for the namesake of diversification and diversify in some poor investments. If you have 20 investments and they're all 20, you can be probably diversified as by your definition, whatever diversity or whatever their definition of diversification is. But if you have 20 poor investments, you're going to have a poorly performing portfolio. If you have 5 or 10 really good companies, then you're going to have a really good performing portfolio. I look at the companies that I own, I think they're different enough. Apple is different from Home Depot, which is different from MasterCard, which is different from Broadcom. And so for me, I almost make sure that I don't look. Like I cannot tell you what the sector makeup is of my portfolio because I don't put that much emphasis on it because the emphasis relies for me comes, do I own good businesses? And if you own good businesses, the analogy I put up, like if you own Home Depot and Lowe's, those are pretty much almost, they're not the same company, but they're the same company.
Mhm. Yeah, yeah, yeah.
If you own just those two companies for the last 35 years, you'll be you have, $20,000, you have anywhere close to 15 to $20 million
Yeah.
just on those two companies. So if you own good companies and you're not really stressed, Warren Buffett, I watched all of his the Berkshire Hathaway annual meetings, and he always talked about him and Charlie Munger talk about diversification really is.
Oh, Charlie Munger's not a fan of diversification.
Oh no, no.
He is anti-diversification.
Yeah, he said the best thing to do is to find the good companies and non-diversified and
Yeah.
put your money into them. And Warren said that diversification is the protection against ignorance, is
Yeah.
what he stated. And ignorance doesn't mean stupidity in that sense.
It's lack of
Ignorance means
knowledge.
lack of knowledge. Yeah.
Yep. Yep.
So it's a lack of knowledge. He said if you don't know what you're doing, then it's okay to own everything. But if you can identify a few good businesses, you own those businesses, then you're gonna be fine. Even when I found Broadcom, I didn't even look at any other. I didn't look at the sector. I didn't look at any other companies that was in that sector. I saw they signed a deal, and it was on a Thursday. So that weekend, I just looked strictly at Broadcom, the company. I looked at Hock Tan. I know they had just moved from Singapore to back to the United States, their home base. I remember when he went to the White House when Trump was president at the time. He announced that Broadcom was moving back. I know as a Hock Tan had been the CEO since 2006. I look at their compounding record. I look at the way they pay dividends, the rate that they grow their dividends, and the way they compound their dividends. And I said, and I felt like by already owning the Apple and the Amazon, and then adding in the Broadcom, and then later on a couple other ones, I said if I believe if I'm right about Broadcom, which I think I am, I've been right since I owned
Yeah.
it.
So far, you're right. Yeah.
Yeah, exactly. And just dating back, I said if I'm right about this company, number one, I'm never going to have to sell it because the way they grow their income, the income is going to be so much in 10 years that one company could possibly cover, everything in addition to anything else. But it is a great company that you can own, that I can really focus on and just continue to add to. So I don't really stress that much from a diversification standpoint. For me, it's about the business. And then the risk I talked about earlier. The risk comes down to me is in the quality of the business and the price you pay. You can overpay, but because I don't save some big lump sum of money to try to dump into one stock at one time. And I've only added one new stock in the last 3 years, and that was Tesla last year.
Mm-hmm.
The aspect of now of me just adding in and building on what I've already had, the risk is more minimal. I use the analogy of driving. I say like I forgot the exact number, but I think that auto accident is one of the leading causes of death. When nobody gets in the car thinking like, oh my God, this is so risky. I got to make sure I drive this way and that way to make it to work in the morning. So there's a different level of risk in me getting in my car and driving, and my 14-year-old daughter getting in the car. Like, she's never driven a car, so she starts driving, and then there's a different level of same activity, but there's a different level of risk. Now I can get in the car and drive, and the risk level, it could be here. Now, if I were to get in the car and drive after I've drank, a fifth of Hennessy or some tequila, guess what? The risk level is not the same.
Yeah.
So I look at that as like, somebody who's constantly day trading, constantly moving money around. So that's how I equate. So the risk level goes up here because your activity that you're actually doing increases the risk. Whereas if you're just owning good businesses, the risk level is because I don't view declining stock prices as a risk. Some people look at it like they look at risk tolerance. I don't do risk tolerance surveys. I stopped doing those. I looked at them, I read them. I was like, to me, a lot of them were designed to create fear, because fear is a greater motivator of action. That the fear of loss is a greater motivator of action than a desire for gain. So sometimes these things can create fear. That way, the money managers can control how you're. They say, "Oh, we need to balance here because if it's not balanced this way, then you're going to lose X amount of money, or there's a fear that you're going to lose money." Or when the market's going like it's been going 2022, people who are afraid that they're going to lose money, they think that they have all this extensive risk. Now, I know there's risk involved with investing, but I don't view it as though like I'm going to wake up tomorrow. If I wake up tomorrow and Amazon and Apple and Broadcom and MasterCard and Home Depot and Lowe's and and Nvidia, if all these companies are out of business,
we got bigger problems. We got bigger problems.
It's a whole lot bigger problem.
Yeah.
I just think that just owning good businesses and just recognizing that there are going to be times when the stock price depreciates. Charlie Munger said that if you cannot act with equanimity, if a stock you own goes down 50%, then you shouldn't own stocks.
Yeah, that I really like what you said about the diversification, because I've thought before, I think the only two sectors that I don't own are utilities and communication services. I personally am not a fan of communication services. I don't think there's anything in that sector that's worth a can of beans, to be honest.
Yeah, I'm just saying, I don't own. I just know from the standpoint that I don't own any utilities. I don't own any communication service. I don't own any energy stocks either.
I own Exxon.
Okay.
I've had Exxon. That was actually one of the stocks from that 37 list. Exxon and AbbVie were two stocks from that list of 37 that I've kept.
Yeah.
Like the whole time.
I had Exxon and Chevron, but those two bit the bullet in 2020 when I found Broadcom.
Yeah.
Yeah. I was like, I felt that I found a superior investment, and I said, I can. And I always like Dividend channel. I'll put them up against each other, and I said, would I rather have this money for the next 20 years invested here in these companies, or would I rather have it here? Now, I always monitor the companies I look at. I always pay attention. And by the fact that like you own 11 stocks, I own 15, it's much easier to follow just the companies you own than trying to be out and follow 100 different companies. I got 3 daughters. They play sports.
Yeah.
Like, I don't have a time to try to look at 100 different companies. I'm still learning more about Broadcom. So the risk aspect of, like, I'm not trying to take money from one company, because all I'm doing is just moving it around within my own portfolio.
Yeah.
So I don't have a
Well, then
watch list
what you were
anymore.
saying before, you're uprooting that tree. You're messing up your own compounding if you keep moving all those positions. So
Exactly,
yeah,
exactly.
I like that. So selfish question here, because I don't do like quite literally when I talk on the channel and say I keep it stupid, like real
Hmm.
simple,
Hmm.
is I don't really like when you, for instance, PE ratio.
Hmm.
PE ratio, very simple metrics, price to earnings, like we get all that. But like PE ratio from sector to sector is different. PE ratio for certain companies, you pay a premium. And then there's PE, like you said, for Costco. Costco has been overvalued forever. And that
Hmm.
stops people from buying it. That's also why I made that video called Stock Price Doesn't Matter. Like you were
Hmm.
saying before, just buy the company. Don't
Hmm.
worry about identifying a solid price. Just buy it when you identify it, and then have a plan of what you're going to put in and how frequent you're going to put it in, and then just keep adding to it. There's people in the group that we're in that have quite literally said that they don't own stocks like Apple and Microsoft because they were waiting for a certain price that it hit, and they've never hit it. And I'm just like, you've missed out on thousands of percent all because you wanted it 2% cheaper.
Yeah.
And I don't understand that. So the selfish question I have is like, when you're deep looking into some of these companies that you're looking into, do you ever like, is there value in looking at like the investor presentations that you can find on their website, or is that just like the Instagram for the company where they're like, here's all the fancy stuff that we want you to see and don't worry about any of the bad stuff, or like, are those things actually like good to look at?
No, I look at them. Broadcom is the one that I really look at. You can tell my love for Broadcom.
Yeah.
Like
Hey, it's made
Broadcom,
you a
I
lot of
really.
money. We don't like the things that lose us money.
So yeah, I always go through and I look at the presentations because I want it to be simple. I want it to be simplified. I like when they have the presentation that
They're all
has the
pretty. They're all colorful. It's yeah, they're
yeah,
nice. You don't got to look at
exactly.
a text document for 500
Exactly.
pages. Yeah.
Exactly. When I see it's like I click on, they be like investor presentation, and it's like 120 pages. I'm like, let me see what the pictures are first.
Yeah. Show me them
So
charts.
exactly,
Yeah.
exactly. So I look at that. I always the companies that do the shareholder to letter to the shareholders. I always read the shareholder letters. I go through and I look at the balance sheet, the cash flow statements, and I'm not pulling. If one thing like the Charles Schwab kind of calculates like a 5 year, the revenue growth rate, the earnings growth rate, the cash flow growth rate. So I look at it. I when I pull it when I pull it up, it actually shows.
Hmm.
There are a lot of websites where they have the numbers that kind of you can look at, and it kind of like stands out. Uh, like what is the revenue today, not versus last year, because revenue can change from one year to the next.
Yeah.
I think Apple revenue in 2018 was less than it was in 2017. One of those years, but then you look at where it is now compared to 5 years
Yeah. It's the
ago.
trend that you're looking for.
Exactly, it's a trend.
Yeah.
So like you don't have to be this expert. If you can just identify, like what, if you just like look at the company, just look at the company and just use your critical thinking apparatus and look at the company. Use your cerebrum and say, this company. Look at all the way. And like Broadcom is. I was watching Hawk Tan's interview. It said 99.5% of all internet data crosses at least one or more Broadcom chips. Now, if you think about all the data, every time you shop online, every time you use a credit card, every time you book a flight, everything, all that is crossing Broadcom's data. They are so entrenched in everything internet. So it's like they're one of those companies to me that you can just own and they just continue to grow. And I know that's probably answering one of your questions that you have about like the one company or whatever that like the for me it's Broadcom. The one company, if you can only invest in one
Oh
company,
yeah. Yeah.
yeah. Other than Apple, which I would say will probably be one of the best companies, but Broadcom. Broadcom, they've had Hot 10 CEO since 2006. Since 2010, when they re-IPO, they've compounded at roughly around 35% a year since 2010, basically doubling investors' money every 2 years. Since 2016, the dividend growth has been 38% a year since 2010. So basically doubling your income every couple of years. In fact, a $10,000 investment in Broadcom in 2010 would be worth $595,000 today, and it would be paying you $12,000 a year in income. It would have paid you $12,000, so you would have got more last year over a 13-year period. And the reason why they grow their income is because their capital allocation policy is the return of 50% or roughly around 50% of the previous year's free cash flow back to shareholders. So Haktan in the interview, he said that the shareholders let though we return 50% of the previous year free cash flow to shareholders in terms of a dividend, and they keep the other 50% for the next deal. Because Broadcom has 22 independent franchises under their umbrella that they bought. They bought Symantec and CA Technologies the last couple of years. Now they have this $61 billion deal for VMware on the horizon. So if that goes through, they're constantly adding on to the portfolio. He does it similar to what Warren Buffett did with Berkshire Hathaway, which is buy businesses. So he's buying. He bought the semiconductor industry, and now he's buying software companies to put in there to broaden their horizon. And they always return 50% on average of their dividends back to shareholders. And so I look at the free cash flow on their cash flow statement, and you can see the growth every year, their free cash flow, and it matches, the way their dividend is growing. So by looking at that and just seeing how the company continues to grow, how it continues to put more money back to shareholders, and by just reinvesting the dividends now, the income is growing at such a rate. When I first bought Broadcom in 2020, it was $13 a share in dividends. So now it's $18.40. So that's 3 years later. It's $18. It's grown by $5.40 per share in dividends. Like, I don't know any other company that's grown by that amount, and they're not stretching it. Everything is based upon the previous year's free cash flow. They just did their earnings recently. The free cash flow has continued to grow over the year before that.
So where do you find that in the letters to the shareholders, or is that in the investor presentation where they fully disclose, like, hey, this is our plan and this is how basically they're determining that we're always going to keep around a 50% payout ratio? So like, where do you find that information?
Well, Broadcom, it's on their website. That was in the investor presentation, but also I go through and I listen to the conference call when they have their earnings report. They do the conference call, so I listen to the conference call. I might do that while I'm at the gym. I'll go to the investor website, then type in, listen to the conference call when the other companies get not the company, the banks and all the other investors, not the retail investors, but
institutional investors.
Yeah, institutional investors get to go on and ask questions.
Yeah,
to the CEO. So I go through, I listen to that, and they've reiterated that before, and it also shows up on Broadcom's website. Most companies are going to have, they don't necessarily say the percentage per se. I think that Lowe's typically wanted to stay in.
Lowe's is creeping up, isn't they? I think the last time I looked at Lowe's, they were in like the 60s.
What's that?
The payout ratio?
Oh no, there's always in around between 20 and 30%.
Okay, yeah, I looked at somebody's and they were like surprisingly high, like higher than I thought they would be, and I don't, because like I was thinking about adding one other thing to my criteria. Like I already mentioned the first three. I was thinking about adding the payout ratio there, just because I do value dividend increases a lot. And if you do have a higher payout ratio, there's just a limit to how many of those big increases you can offer, unless you have some exponential growth. And the older a company gets, like you were saying before, like a bigger percentage of a bigger the same percentage of a bigger number is a bigger number. So like if you go through and like Apple is no longer going to grow at 50% a year because they're already the biggest company in the world. However, you could get some of these smaller companies that can do 50% in a year because they're a tenth of the size, a hundredth of the size of Apple. So it's one of those things. So I'm trying to determine what my payout ratio criteria would be, because like I want to keep those three metrics. They've done well for me, and it's keeping it nice and simple. I do like like I said before, I like what you said about the diversification, because I don't want to go. I wasn't going to go into utilities. Utilities, there are some really good ones in there, but it can't be utilities. It's something else, because I have NextEra Energy, and that's a utility. But there's another company. There's another sector that I don't have. There's two sectors.
Telecom.
Yeah, telecom and something else. I don't remember what it is. But like, to what you were saying before, is I don't feel the need to go out there and be like, oh, there's two sectors I don't have. Let me find something, and like the next stock I have to buy has to be in those sectors. Because like, if those sectors aren't what I need right now, or they just don't do it for me, I'm not going to put money into it just to be diversified. Like, that don't make any sense. So, so all that to say, like, I'm trying to really figure out the payout ratio of like, okay, I want my companies to grow, beat the market, have a dividend streak to show their consistency, and then also grow their dividend at north of 10%. and they need a low payout ratio to sustain that. So like I don't know, maybe like 40%. Is what
Yeah,
going to be my cap, and if I can find a company that meets all four of those criteria, then we're in. And maybe I
yeah,
will start doing what you said, and like more or less like don't really worry about the sector, because if it's a good company, it's a good company. So
exactly. And I
I
look
do like
at,
that.
for me, ideally it's under 50%.
Yeah,
I think most of the companies are under 50, definitely under 60. I don't go above 60 at
yeah,
all. That was one of the reasons why PepsiCo was, I own it, but a lot of times the growth rate is extremely important. So I use the chowder rule too.
hmm,
I look at the dividend yield plus the 5-year dividend growth rate. I want, because the dividend yield is what you're being paid, and then the dividend growth rate on top of that is the money that's growing on top of what you're already being paid each year. So I look at that. I prefer it to be 15 or higher. The only company that I don't have that doesn't uh, surpass that number is Lockheed Martin, and I bought it. I've had it for a while, and they got Jim Takelet, who's the CEO now. He was the CEO of I think it's American Water Tower for like 20 years, and he just became the CEO of Lockheed Martin about 2 or 3 years ago. And he grew the company, I think, from 2 billion to 200 billion. So that's the one company that doesn't have the dividend growth rate that I like. I prefer the chowder number to be greater than 15. That way, I know I'm going to be compounding my money at a high rate, or my income at a high rate for a long period of time. So I look at that and look at how the companies increase their dividend over time, and also how they buy back stock. That's another way that your money can grow from a capital standpoint.
hmm,
So the income grows based upon how they raise the dividend. So that's important.
yeah.
And that, well, I think return on equity, looking at that and just seeing what that is from a standpoint of how much, what's the return on equity. If you got a good company, most of the time you're going to have 15-20% or higher return on equity.
Yeah, yeah, I like it. I like the simple metrics. Like I said, I don't do the investor calls and stuff like that. Not that I don't want to do them. It's just
Mm-hmm.
the YouTube channel takes 900% of my time, so I
Yeah,
don't
yeah,
I don't
yeah.
have a lot of time for that.
Yeah, that one I just started doing it. I do it when I'm like I say, I'm at the gym, I'm working out. So I used to initially I always listen to music, and then I did the Berkshire Hathaway annual meetings. I used to listen to those while I was working out. I listened to Common Stocks and Uncommon Profits by Philip Fisher. I probably listened to that book probably close to 50 times.
do you get
That's
any
the one
different
book that
value
has the most influence.
from listening to a book than reading it?
Um, I do both. I do both. I
Okay.
think what happens is when you listen to it like multiple times, every time you go back or every time you start over again, nothing changes in the book per se, but it's pretty much something's changed in you. Your knowledge
Yeah.
is increased, so you hear the same thing, and it might hit you a different way.
Yep.
And it's much easier because you can listen to an audiobook when you're driving, when you're working out, and when you're doing other stuff, as opposed to when you're reading, you got to actually sit down and read it too. So I prefer reading books, but I take advantage of listening to them too, especially when I think I have a good one that I can really trying to learn stuff from or pick up stuff from. I listen to the audiobook. I tried to read um, Influence is by Robert Cialdini, Influence, Psychology of Persuasion. So I tried to read that book. I read it and started through, but I got the audio book. I just listened to it and I read it. So I just trying to pick up on how people, persuade you to do stuff. And so I like to listen to audiobooks, and that helps out from a growth standpoint because you can find yourself doing a lot of stuff, and you can use that time for learning
Hmm.
as opposed to, I know, because you talked about working out. If you can work out and you can learn at the same time you're working out, you're improving your mind and your body all at the same time.
Yeah. Yeah, I try to I don't I work from home, so I don't go many places. So on the way to the gym, on the way home from the gym, I listen to a podcast called Mind Pump. It's
Mm-hmm.
a fitness podcast, and they talk about like finance in there. They talk about conspiracy theories and all kinds of stuff. And then like I said, I'm really big into fitness. And I listen to that, and I can listen to podcasts on 3.5 speed, which is really cool. Like I had to build up to there, but now when I listen to it on 1 speed, I'm just like, why are they talking so slow? Like, what are we doing? So yeah, I do that, but it's just I've never been a big reader. I like to
Mm-hmm.
listen more.
Mm-hmm.
And same thing with YouTube. Like I feel like I can learn something very complex on YouTube if there's a video. But if I just have to listen to so it's levels. Video is my favorite,
Mm-hmm.
audio is second, and then reading is my least favorite, just because like sometimes it just doesn't connect. Like same thing with school. Like when I was in school and they're just like read this chapter and then here's a test on it. I'm like I can't compute with that. Like it doesn't connect with me. So but then if I go like now, if I was in school now, either chat GPT and then you can just get it to read it to you, or you could just go on YouTube and type in what is this, or if there's a TED talk on it or something like that. And I feel like I can learn. There was a video on that Vox did, which they're the ones that are behind the Explain series on Netflix. If you haven't seen the Explain series, that's one of my favorite series on Netflix. They have an Explained Money series, very good series. But Vox is the series that, or the producer that's behind that. They did a video, I think it was 2 or 3 years ago, explaining the debt ceiling, where the money comes from, why it matters, the debt ceiling from the United States compared to other countries, how it started, how it's gotten to where it is, all kinds of stuff. And it was a video, and I feel like I know so much about the debt ceiling now, but I've been hearing about it before. I've read
Yeah.
about it and all kinds of stuff, and it just doesn't connect. But then when I watch that video and I'm just like, man, this, now I get it. Like everything makes
Yeah.
sense.
And
So,
that's one of the things too. Like when I teach my teach class, and you have to for me, I have to learn how to cater to different people, because I would say there's three different types of learning: there's auditory, there's visual, and there's kinesthetic. So you have to be able to teach in different ways. Like I'm a visual person too. I like charts, I like graphs, and some people are real auditory learners. They can just sit there and listen, and they can just pick up whatever you're saying, and it makes sense. Some people are more visuals, like they can listen to you, but if they don't see it, it doesn't make sense. And then some people are like kinesthetic, so they got to listen, they got to see it, and they got to do it. Whether it's taking notes, which activates another part of the brain, or we're all a combination. There's some area that might dominate. Some people might be more visual, some people might be more auditory. Some people to read, it requires patience. With the three girls, that's why I got more into the audiobooks. Because if I'm, them helping them with homework, I don't get a chance to sit down. I might, pick out a book and then just fall down and read. But fall asleep while I'm reading. So one thing I did try to do from a reading standpoint, I heard Napoleon Hill talk about this, is to work on your ability to communicate, is to read out loud 10 minutes every day. Just kind of verbalizing, using like different, trying to see the words, different voice controls, just learning how to be able to communicate better.
like tones and cadences.
Yeah. So you're reading like with enthusiasm. So you're trying to read in a standpoint where you can actually be able to project. Like you do a really, really good job of communicating and speaking and doing these particular things. And I went to Toastmasters really because my speaking ability, I wanted to learn how to present better, to speak better, without using all the ums and the ahs,
Yeah.
which affect a lot of different people. Some people are natural with it, but for me, it's always about growth. I don't think that we should ever stop trying to grow,
Yep.
and stop trying to learn, because I think the more you learn, it's like if you stretch a rubber band, and the more you stretch it, it never goes back to the same size. So with the mind, the more the mind stretches, the more what you think you're capable of begins to expand. That's one of the reasons too. Like you got your channel. I started my YouTube channel, Healthy You, Wealthy You, and mine is about health and also generational wealth as well. And just like you interviewing different people, one of the things that I'm focusing on starting to do on my platform is to interview different professionals from the medical community, optometrists, cardiologists, orthopedic doctors, so people can be able to come to the platform to be able to get educational material, because that's the whole thing. Like Healthy You, Wealthy You, the U has two connotations. The U is for you as an individual, like you got to take charge of your health and you have to take charge of your finances. And also U stands for university, because it's an educational platform that I'm trying to build. Just like you with the Dividend Obsession, it's an educational platform so people can come and they can pick up, if somebody comes and they pick up one or two things from an interview that you do or from one of your videos, they can change their life or change their kids' life or kids' lives, or basically really change their family tree. Then you can have everybody that you talk to, you can go out and talk to people till you blue in the face. And some people are going to look at you and be like, oh, okay, cool. Yeah. Okay.
Yep.
And then you can notice it because you probably run into that brick wall all the time when you're talking to people about investing. When I'm talking to people about investing and stuff, oh, I got somebody that does that for me.
Yeah.
You know what I'm saying?
I'm like, what are you invested in? They're like, I don't know. I'm like, how much you paying them? They're like, I don't know. I'm like, all right, well, you just, like, you just don't, you hands off. Yeah.
Exactly. Oh, and then you asked earlier, I don't think I answered this one, about why people don't really get into dividend investing.
Oh, yeah.
Yeah. One of the reasons, the first one you already said it, is because they think it's too slow.
Yep.
It's slow, and it's the microwave society. Everybody wants to get rich quickly, and that's what happened in 2020. Everybody wants to get rich quick, and also too is because the financial community does not promote it. Because to to promote dividend investing, the true value of dividend growth investing comes from owning a great business for a long time. The money managers cannot make money off a person who owns the stock for a long period of time. So they make their money from transaction costs and commissions. So your account has to be churned. You got to rebalance it every quarter. You got to rebalance it every year. A lot of times people don't realize that every time you rebalance your portfolio, you're losing money because you lose the fees, you're losing it to transaction costs, you're losing it to commissions. So if you go up and you talk to any manager and say, "Hey, I want to get into dividend growth investing," no, that's not a good idea. You
Yeah.
can't. They would try and talk you out of it because the true value comes from you owning good businesses for a long period of time, and that's where you make your money. Your money is going to be made, 10 or 20, 30 years from now from owning really good businesses, not from constantly jumping from one place to the next. So they're not going to promote something that any company that they work for can, because they have to make money too.
Yeah.
The manager, if they don't make money for their company, they're not gonna have a job. So they
Yeah.
gotta sell products. They gotta sell you your annuities. They gotta sell you your whole life insurance policy. They have to do all this stuff so that they can make money, but you lose money. And like I said, that's one of the things I talked about. If you go in, you meet with somebody, and you have zero knowledge, everything they say sounds like is the gospel. So you just gonna take their advice. You said they're experts, and that was one of the things I talked about when I talked about the book, Influence by Robert Cialdini. One of the things of persuasion is authority. So people are persuaded by authority figures. You look at somebody and say this person is a doctor. So whatever the doctor says, I'm just gonna take their word for it. And a lot of people don't question their doctors. I say it's your body, you got your health. You have to ask questions. It's the same way with your money. A lot of people take the authority figure and say, this person has been managing money for 20 years, so I'm just going to let them do it because they know what they're doing.
Yeah.
So,
It's the same way, like, and it's, I think it's impossible to be an expert in everything.
oh, yeah.
Because they say it takes you 10,000 hours to become like an expert at your field or whatever. So like, it's the same for me. Like, I'm not really into cars. I don't know a lot about cars, like all the things. So when I go in and I get my oil changed and they're like, "Hey, you need a filter," I'm like, "Sure." Like, I don't know. Like, I wouldn't fall for like super simple stuff where they're like, "Your blinker fluid's low." Like, I know I don't have no blinker fluid, but like, it's one of those. And the same thing with the doctor's another good example. Like, you go in, not many people get second opinions when they go to the doctor. They go to their doctor that they've been going to for a long time. This person went to school for all these years. This person went into a lot of student loan debt to be a doctor. They're going to tell me, "Hey, something happened. You need this surgery." And then like, you get that surgery. And instead the wife just had this. They said that something was wrong with her gallbladder. She went to another doctor and the doctor was like, "Your gallbladder's fine." So like, had she only went to that one doctor, she'd have her gallbladder out. I mean, you don't need a gallbladder or whatever, but that's still a surgery that she doesn't need to get. So it's one of those things, and I'm just like, you have to be careful. And that's really the scary part about where we're going in today's society is like, it's almost not beneficial to trust anybody. Like, you have to do your own research, but like I said, there's a fine line because you can't be an expert in everything. Exactly. So like, you have to like really, really narrow down, like, who can you trust, why can you trust them, all those things, and it is a balancing act. But you really have to understand, like, okay, for me with fitness, like, I can talk to somebody at the gym and within 5 minutes I know if they know what they're doing or not, just because they've been going in there, they do the same weights, they do the same sets, they do it in the same order on the same days every day for the last 10 years. You're just there for maintenance. And at that point, you're not making, there's no progress being made. And I can argue if you're maintaining over a long period of time, you're really losing. Like, there's not inflation on your body, but you're not making progress, you're getting worse.
Yeah.
So it's the same thing with your knowledge. Everybody's like, "Oh, I'm trying to, I already know a lot. I don't need to know anymore." You're getting new things happen every day. And if you're not learning anymore, you effectively know, it's almost like share dilution. There's more and more shares of knowledge being issued every single day, and you still have your 100 shares that you had from 1982. You now know less because there's more things to know. So
exactly.
I don't know. I just thought of that. I thought that was pretty good, but
Yeah, write that down. You
yeah, hey,
gotta.
that was. We'll put that at the bottom of this or something. But okay, so
Another
real
good
quick, I
thing.
wanted to ask you. I have a question from Lewis, one of my subscribers, and he wants to know, what do you think about newer folks using the Dividend Kings and Aristocrats list when getting started? So what do you think of that as like a baseline list?
I think it's a good list to look at from a standpoint of well different companies. Then you also got to look at because there's a lot of companies that have paid dividends. 3M is an example. I do
Mm,
not like 3M it's been for the last 20 years. It's been a below average investment, to say the least. So just because it's a dividend king and it's paying a dividend for X amount of years doesn't necessarily mean it's still a good investment today.
yeah.
Well, you got to look at, okay, how is it? That goes back to looking at how the company has performed over the last 5 years, 10 years, 20 years. So you can look at the list and start from there. But, as Peter Lynch said, buy what you know. Start from what you know first. Look at the companies that you utilize the most and look at their position in their field. They're dominant in their field. How hard is it for is as like retail. It was is a lot in 20 and when COVID hit, is a lot of retail stores that went out in 2020 because it's like okay, you can go to this store and get this, you can go to this store and get this. So a lot of retail stores suffered. And you look at a company that like how dominant are they? Can anybody come and just easily take away their customers?
Hmm.
So Apple is one of those companies like you can go to Google and get a phone, I guess. But it's difficult to get within that sphere.
Hmm.
So looking at those companies are a good way to look at getting started. But I wouldn't necessarily say just because they're a dividend king, there's a company that's going to be the number one on my list. Because
Yeah.
I can look at it, then I want to look at okay how like I think Lowe's is one dividend king that I own, and might be the only one I own. So
I'm trying to think for me. I own Illinois Tool Works. That's a king.
yeah, I looked at it before.
The payout ratio is a little high. That's what I've had for a while. I'm trying to like. That's why I'm asking the question about like the investor presentation and stuff. I really want to dive into some of these companies that I've had for a while
Mm-hmm.
that just met this numbers and the numbers that I set in the beginning and like really understand like kind of like sell myself like hey, this is like I already know why I bought it, but like what
Mm-hmm.
is it still doing? Is it still meeting those numbers? How do I project it's going to go in the future? Like stuff like that.
Mm-hmm.
So Illinois Toolworks is one, and for Lewis, I think the big thing here is really the list is a good starting point. The thing that you want to have is you need to make sure that you have the criteria ahead of time. You
Yeah,
need to
exactly.
have the list. Like I do the same thing with my Power Five that comes out every Friday. Like
Mm-hmm.
I've had people say that I'm out here trying to get like the dividend capture, where I'm trying to get people to buy it before the ex dividend date and sell it.
Yeah, yeah,
I'm not
yeah.
doing that. That's not what I do. What I do is there's thousands of stocks out there, hundreds of which pay dividends. How I need something to narrow down this list. So I just
Mm-hmm.
like, okay, what's a list that changes every week? The ex dividend dates change every week. There's new companies on there. I'm going to start my filters through that list. So you can do the same thing with the Kings and Aristocrats. Kings and Aristocrat, stable list.
Yeah.
Then you add your own filters to that list and say, okay, I want a King and Aristocrat. So there's my one list. So it needs to have a dividend streak of 25 years or more. That's one of your criteria. Then what? What else? Like, for instance, Tootsie Roll is a dividend king. Don't look at Tootsie Roll's performance over the past 10 years. I'm pretty sure it's negative.
Mm-hmm.
I'm pretty sure they're like 10 years ago, 10,000. I think it's like 8,500 or something like that last time I looked.
Yeah.
So they've actually lost you money over the last 10 years. So, like he's saying, like, you can't just king and aristocrat, it's going to be a winner. That's not how it works. It's a good list to look off of, but you have to have supplementary criteria to judge these things by. So,
Yeah, that's a good point. You look at the list and then you look at your criteria because I know one of yours is dividend growth rate. A
yep.
lot of the kings are what Peter Lynch calls stalwarts. So in football, they'd be like the offensive lineman.
Yeah.
So they're not going to be the skill position players that's going to get you the touchdown.
Yeah.
They can be a part of your team, but they're not going to be growing their dividends at 15%.
Yeah.
So their payout, they may have a certain payout ratio, or they grow their dividends at 5% a year, 6% a year. There's nothing wrong with that if you are, at that point where you just like, I just want to own some companies. But if you're trying to really grow your income, you gotta get that 15, 18, 20% dividend growth. And even when you add in new capital, that adds into the growth as well.
Mm-hmm.
But adding a company because it's a king and it pays 5%, you got to have your filters. It doesn't have to be a whole lot.
Mm-hmm.
You got to have your filters that you put them in. So I put a company up, and I have like all the companies I have like 2 or 3 different spreadsheets. One I have was like my valuation, so it has the number of shares, the cost basis, the market value, and another one has like dividend yield, dividend growth rate, PE ratio, return on equity, and all these things. So I put up and I put it, they're color coded. So if a company has like say 15% or greater uh, uh, dividend yield, or like it's growing at greater than 15% over the last ever many years, it might be colored purple. And if it's less than 10%, it'll be red. And I say, okay, why do I own this company?
Yeah.
If it's not growing at a rate that I find that's satisfactory over the last 5 to 10 years, that doesn't necessarily guarantee it's going to grow in a forward, but grow the same way going forward. But if you get to a point where you own a group of companies for a long enough time, you realize these companies tend to grow in a manner that's very, very consistent with how they performed in the past until they get to the point where either through the passage of time or the company's gotten mature to the point where it can no longer grow, then you can make a decision from that standpoint. So a lot of the dividend kings are quote unquote mature companies.
Yeah.
If you look at Lowe's is increases dividend for 59 years in a row and still growing its dividend at 18 to 20% a year.
Yeah.
Because of the low payout ratio.
That's one of the things I look at on the Power 5 that I release on Fridays is like sometimes that one that is the longest dividend streak, sometimes those have really, and like it always surprises me when I do that research. I'm like, man, not only have they grown for 30, 40, 50, 60 years in a row, but their dividend growth rate is also this. And like I like to like connect the dots with certain companies where it seems like when I find these companies with the higher yields, as soon as I add the filter of outperforms the S&P 500, most of them fall off. And then when I find the companies that are the high dividend growth rates and the best 10-year performance, so category 3 and category 4, they often have lower yields and higher dividend growth rates. So it's just little dots that you're connecting over, I don't know how many months I've been doing this Power 5 series, and it's just like, okay, like, and for example, what you were saying about the filters, literally, I think it was the video that just came out of the one before that, there was like 245 different stocks that had X dividend dates. I added 2 filters. That's it. Dividend streak and outperforming the market. That's all I did. And it went from 200 down to like 40. And then you can go from there. And like I said, if you're looking for it from sector, you can filter by sector. If you're looking for a certain dividend yield, you can filter by a yield or whatever you're looking for. And you can, like, I don't filter by dividend growth rate on the Power 5s, but if they were my stocks, I would. I'd go, so I don't know if you use this resource, very good resource, not sponsored. Dividend Radar is the CCC list, and it is a free, you can just go on Google and type in Dividend Radar, and it's a free resource, and every Friday you can go on there and download the new CCC list that is updated automatically by their algorithm. And it's all on an Excel sheet. So you can sort it by the champions, the challengers, or the contenders, or you can sort it by all of them. That's how I found Costco to buy with my NVIDIA funds. I was like, I want a stock that's in this sector because I wanted a stock in that sector. I sold out of technology. I wanted a different sector. Obviously before our conversation. And then I looked at it. I was like, okay, I want a dividend growth rate of this. And I sorted it by all of them. It has 1, 3, 5, and 10-year dividend growth rates on there. So I sorted by all of them, and I said I want every single one of them above 10%. And I did that. It narrowed it. I think there was 3 stocks that were in the sector I was looking at that met that criteria. And then I just went on, compared them to the S&P 500, and I did it from there. And it took me 10 minutes to pick that stock because it met all my criteria. My criteria is simple. It checked all the boxes. We're good to go. And like I know things about Costco and stuff like that, so it wasn't like, oh, it just meets and blindly invest in it. Like I've heard about Costco. I've been to Costco. I know all the things. So yeah, it was one of those things. But yeah, so Lewis, your question. Dividend Kings, Aristocrats, good list. Make sure you have supplementary criteria to judge these stocks by, or just don't blindly say it's been paying for 50 years. It's got to be a good company. That's not how it works. So
yeah, get that criteria and investing. Like you said, it can be as simple or complex as you make it. I don't have to be an investment guru. All I got to do is just own the good companies.
Yep.
The people who make the most money, They run the companies.
Mm-hmm.
I just gotta own them.
Yeah, they're the ones that got to be smart. Like,
Exactly.
yeah, yeah,
So
no,
I either gotta be like a little bit smart or a little bit lucky.
yeah,
So
yeah, yeah. I like that. Okay, so next question. We have like two or three more questions here. So, are there any dividend related misconceptions or myths that you would like to debunk? So, example would be that like I said before, dividends are for older people, or past performance doesn't matter. So, is there anything, maybe those two, or anything else that like you always hear and you're just like, that's just not true?
yeah, the one that people always talk about, the past performance doesn't matter. You know, that I think that's said so much. It's one of those things where you hear it so much, your mind just automatically accepts it.
Yeah.
Past performance is no guarantee, so I'm not going to even look at past performance.
Mm-hmm.
But if you really look at the companies, the good companies and how they perform over a long period of time, like when people say, I wish I'd bought Apple or such and such, 20 years ago. Well, I didn't buy it 20 years ago. I bought it 7 years ago. Guess what? It has still performed at a high level, over the past 7 years, especially if they have a dominant position. They have really good management who's run the company for a long period of time. Then most companies are going to perform at a high level. Or continue to perform at a similar level. That is why Lowe's, who's I use the example because I use them there, but Lowe's, who's been growing their dividends for 59 years, can still compound at 15% a year, not just in dividend, but also capital appreciation, because it's a good company and they still continue to grow. Like inflation hits the spenders, but also the company. You got to go to the companies. They have to raise their prices, so the companies are going to continue to grow at the same time.
Mm-hmm.
There are certain companies that can't raise their prices so much, like Procter and Gamble, in my opinion. They can't just all of a sudden raise all their prices for toilet tissue because people go to Kimberly Clark or whatever that they have that's
Hey,
similar.
great value toilet paper works just the same.
Exactly, exactly,
Yeah.
exactly. So that, and also the thing, like you said, is dividend investing is for older people because they look at it like, I just want to have this yield. And one too is that higher yield is better. People shouldn't chase yield. I think that's a mistake that people get. They're trying to get the higher yielding companies so they can get to the income. They want to retire early, so they get the higher yielding companies. You get to a certain point where your income kind of becomes stagnant. If it's not growing,
Mm-hmm.
so it grows really slow. If you're fine with that and say, I'm gonna get to here and I'm gonna stay here and I just want my living expenses covered, then that works too. I prefer to have the companies that grow so that I can kind of project forward in 15 years or 10 years what I have from a dividend standpoint. And that, another one is that companies that pay dividends don't grow.
Yeah.
That's the one that people say, well, I want to have a growth company.
Yeah.
I was like, I always tell them, find me another company other than NVIDIA and maybe a few companies that have done as amount of growth as Broadcom over the last 13 years. That list is not very, very big. It's maybe a few, but Broadcom has grown, but also it grows its dividend at such a rate. And you're going to have a lot of good companies that grow their dividends. So just because the company pays a dividend doesn't mean you're giving up growth because of that. And people separate, like they say, I'm growth or dividend, as though a company that pays a dividend that doesn't grow. It's saying you got some companies that don't pay a dividend that don't grow at all. Yeah. I mean, they grow at a rate that's similar to the ones that, or less than the ones that do pay dividends. So that aspect of it as well.
Yeah, I really like that. It's I hear, so the past performance thing always drives me nuts because what's crazy is, would you rather own a company that has never outperformed the market and then try to project that they will outperform the market? Or would you rather own a company that's shown over the past 10, 20, 30 years that they can outperform the market and they plan to keep doing so? Mm-hmm. Like at that point, it's just like, okay, do you trust them for their word or do you trust them for what they've actually done?
Exactly.
Because like you can what I always pick on AT&T and Verizon. They're just easy targets. But like AT&T, we're making all these acquisitions. We're doing this. We're going to 5G. We're doing this. Great. You've returned like 16% over the last 10 years. Mm-hmm. Like, what are you doing with that? Like, I could have put that in almost everything else, and it would have been better or just as bad. Like, I don't understand. Like, I could have put it in Dogecoin and probably made more money out of than AT&T. But like I said, good thing you got your 7% yield. I don't know, but
Yeah, no. AT&T was one of the companies that I bought when I first started learning about dividends. I saw AT&T's yield. I'm like, oh, I gotta get AT&T has 7% yield.
mm-hmm.
Then I saw like, oh, I put this amount, I'm getting 7% return. Then I started looking at the companies in more detail, really looking at the business. Because I look at all stocks are little pieces of businesses.
Mm-hmm.
And the better the business, the better the stock is going to perform over a long period of time. So I started looking at the business. I'm like, is this a business that I can own going forward and sleep well at night? You know, the swan side, I sleep well at night. So I can sleep well on Apple. Amazon has been kind of up and down the last couple of years, but I've owned it for 7 years. You know, I've owned Lowe's for 7 years. So the idea my income is greater today than it was 5 years ago. My capital is greater than it was 5 years ago. And I expect it to be the same 5 years from now or 10 years from now. And I got the snowball rolling. So we're going to keep this bad boy going.
Yeah. Yeah. It's super cool with the, like, I know a lot of people that they have some of the principles of dividend investing down as far as the reinvesting, like they get the money, they don't use it, they put it back in. But in certain cases, understanding that a company is good or bad, like for AT&T, Verizon, at that point, the company's been depreciating at the same rate that their dividend's been paying. So at that point, you're just trying to stop the ship from sinking with a cup. Like you're just like, hey, we're taking on water, but if I keep dumping this water overboard, like we're not going to sink. I'm like, you're not making any progress. The dividends that you're getting, that the main reason you're there is that 7% yield. However, that 7% yield is just helping you not realize as many losses. That's what that's doing. Mm-hmm. So it's really like you're saying, you have to understand that. And the crazy thing is, like when you think of phone providers, you think of AT&T, you think of Verizon, Sprint or T-Mobile. They merge now, so they're the same thing. But like those are the ones you think of. So when you are like, oh, you know, buy what you use, buy what you know. I know 95% of people that I know as people have Sprint or Verizon as their, or have AT&T or Verizon as their phone providers. So like you're just like, oh, clearly they're doing well. But then you start learning a little bit more and you start looking, yeah, but they're accumulating debt at a pace that their income cannot support. They're literally becoming less and less profitable while accumulating more and more debt. And maybe the CEOs are right and they're like, oh, we're doing all this debt and going into 5G now, but it'll pay off later. Maybe it will. I don't know. I'm not willing to take, like you say before, I'm not willing to take a fifth of Hennessy and take that risk. I'm not willing to do it. You might. Kudos to you. I'm not doing it.
Yeah, exactly.
Yeah. So, yeah, look at that. All tied that in there. So, one of my favorite questions to ask, and I feel like you're going to give me a good answer on this, so no pressure. When or how do you know when enough is enough?
When I reach financial freedom, I would say, well, because one of the things is for me to get to that point, like when you have enough income that covers all your living expenses, then I think at that point you're technically financially free. You also still want to have money. You want to have enough, not just to cover living expenses, but money. Part of it is still in your investment, because I want to invest the rest of my life. Mm-hmm. Like I don't want to get to a certain point where I'm just living off the dividends. My dividends just covers everything, and I don't have anything left over. I still want to be able to invest. So as I'm continuing to invest, then I'm still putting money in. So in addition to the companies raising their dividends, then by putting new capital in, my dividends are going to continue to grow as well. But like I know from the compounding standpoint, because I know what you talk about from this.
That's
from
hard.
a compounding standpoint, like if you get to $70,000 and you say, oh, if I wait 2 more years, I could be at 85,000.
Yeah.
Then you're at the point where. But see, the objective for me is to get to the point where I know I control my hour. Like I don't necessarily believe per se in the concept, the way it's situated in retirement. So I'm not looking to get to a certain point. And part of it has to do with me being self-employed, where I'm not looking. A lot of people work for somebody else. They go in and they want to work until they get to 60 or 65. They be like, when I get to 60, then I can leave. Like for me, it's about trying to, like you have this channel. You're really good at it. So you have this channel. So as you're doing this can end up being like something that if you find like your purpose, you can do that for the rest of your life. If you figure out how to monetize it, you do it you're not thinking like, oh, I need to retire. Like it's something that you love to do, that you can monetize it. When I was looking at like longevity, studying longevity, and like people who live the longest. So they talked about blue zones, like blue zones, and there were five that the people talked about in the book. Three I remember. One was Costa Rica, one was Loma Linda, California, and one was Okinawa, Japan. And in Okinawa, Japan, they don't really even they have the I think the largest group of centenarians or people who live to be 100 years and older. And in their culture, I heard that they don't even have a word that means retirement. Like they have like the three components they have is like one is called ikigai. That's your purpose. Like why do you get up every morning? You got to have a purpose. Like what are you getting up? What are you doing? And if it's something that you feel you're doing for yourself, and you're living from the inside out, where you're trying to do something and spread out to help other people, as opposed to like you feel like you got to go into a job that you hate, then that's one thing. You have a purpose. The second one is community. If you're around a great community, then that tends to help out from a standpoint of everybody's lifting everybody up, and then people tend to grow old together and grow and age gracefully, and everybody's sharing knowledge and everybody's growing from that standpoint. The third one in their culture is like eat till you're 80% full and don't overeat, because that plays a really big part in your health.
Mm.
So you're looking at the health, you're looking at the community, and you're looking at whatever is going to sustain you for the rest of your life, and you're going to continue to grow. And that was one of the things that in the richest man in Babylon, when they talked about Arcad, being the richest man in Babylon, is that even though he was the richest man, the more money he gave away, it seemed like the more he had. And that's the whole thing with Warren Buffett.
Mm-hmm.
He started out at 43 billion. He's giving away 50 billion, and now he's worth 112 billion. So you can get to a certain point where your dividends cover everything. They continue to grow every year, so they won't stop growing. The only difference comes in when you are reinvesting. You miss out on that aspect of the reinvesting. But if you own companies that grow the dividend at 15%, then on average your money is still going to grow at 10 to 15%. So if you're at 70,000, even if you're not reinvesting and your portfolio grows at 10,000, that's next year you're at 77,000.
Mm-hmm.
And then from there, if it grows another 10%, then that's another $7,700 worth of growth. So you're going to continue to grow every single year. The objective is to be able to control your 24 hours, where you can walk away and be like, I don't have to worry about anything. I can go lay on the beach if I want to, and I still have everything covered. When you get to that point where you have everything covered, and like I'm not at that point yet where you don't have to worry. Like, for you have a little one now, so that kind of pushes. You gotta think a longer term period. Like my three daughters are 14, 8, 11, and 8. So I think I gotta think a little bit beyond just myself. I want to make sure by giving them a custodial account, that gives them a really, really, really good jump start. The same for your son. It gives them a really, really good jump start. But if you get to that point where everything is covered, and you don't have to sell your assets, and everything is covered, and even not just covered like you just barely, you don't want to just cover like I'm barely scraping. Like it's covered, and if there's an expense or something like that, something that comes up, your dividends are surplus too. So you have it where it covers, and you also have a surplus each month that you can reinvest back into the company, into the chore company.
Yeah. Yeah. It like you said, the compounding is what I'm going to struggle with. Cause like obviously we both chase the companies that have that big dividend growth rate. Cause there's no better way. I mean, for you don't have a boss, you're your own boss. But like for me, if I'm like, I'd really been busting my butt at work, I'd really appreciate a raise. And then they're like, here's a 2% raise. I'm like, well, thanks for that. But like these companies, I don't have to have that awkward conversation. I don't even work for them. They just give me 10, 15, 20% raises just for fun.
Exactly.
So like that's real cool. And then me being competitive, I know it's just going to be an issue where I'm like, okay, this year it's 60, next year it's 70, the year after that it's 82, and I'm like, okay, I could technically retire off the 60, and I could take the 60 out, and that's my income, and then they're still going to grow at the dividend growth rate. But if I wait one more year, I'm going to have that dividend growth rate and the 60. Like that's how my mind works. And I don't know. Mm-hmm. So I know it's going to be an issue I have. I ask everybody just to really, because at the end of the day, I'm going to be able to reflect on this years down the road and be like, hey, you know what? I talked to 45, 57 people, however many people, and they've all said basically the same thing. And I'm like, maybe I do need to, step back and realize that. So I appreciate the insight on that and the compliments on the channel. And that's another thing.
if I had started this, let's say 2010, when I was doing the mutual funds, if I had started with individual companies and with the dividend growth aspect in mind, who knows? I can sometimes I go back and I do the back testing. I get upset at myself.
You think that's healthy?
I, no. That's it's figuratively,
Uh,
not figuratively.
oh,
So
okay.
I look at it's more like I look back and be like, this is what it could have been, but it's more like excitement going forward because I can
Yeah.
see projecting going
Okay.
forward what it can be. So no, that's a figurative. Like no, not only literally get upset, but I always say I wish I had known.
Yeah.
But that's why my daughter's starting early. But at the same time, you look at that aspect of it and you grow, and especially if you have I document. I put everything into a spreadsheet,
Mm-hmm.
so I know that what my growth rate is every year. And right now, my goal is 18% because it doubles every 4 years. So obviously, I'm ahead of that goal. So 18% it will double every 4 years. I know that for me, I'm 49. I know that at 60, I always instead of 59 and a half, it kind of seems like I just say 60.
Yeah. Yeah. That's weird. Yeah. Yeah.
That's when I have access to my raw. So that plays a role in it too. And from there, everything else primarily because I'm converting my SEP to a raw, and I've been doing that for the last 5 years. I'll pretty soon, maybe another couple of years, I will have all of my money from my SEP to my raw, and then I don't ever have to worry about paying taxes on it again. Money in there can just grow, keep growing, and keep growing. And then when I get to that aspect of it, then I know. I think by the time I get to that access, or that I would love to be able to get there earlier. So I had a map out portion of it. I get there earlier than the 60, and I don't know. I don't have a set. When is enough is enough.
Yeah.
When is it enough?
It's hard.
For me,
It's a moving target too, because like life changes, your lifestyle changes, like you said, inflation happens, like all kinds of
mhm,
stuff goes on. So it's really difficult. And like my approach is similar to yours, except that since I want to retire at 50, so I got 22 years left. So um I have the taxable account that I want to live off of. That's the one that I mean I broadcast all of my accounts on the channel. And that's
mhm.
the other thing. My investing style is so boring. Like I know a lot of people that update weekly on their dividends. I'm like, hey guys, I bought the same companies I bought last week. Like
I
there ain't
know.
nothing fun about that. So I just take my time to do these dividend recaps at the end of the month. And I honestly do think that I went on different channels on YouTube and I was watching all the different recaps, and I wasn't watching them from a like confidence point of view. I was watching them like, what can I add to my recaps? What can I get rid of? Like, what does nobody cover that like I don't need to cover in mine? Like, am I covering too much or what? Because I do, like you said, I have a lot of spreadsheets. I have all the numbers. I know all the things, but like,
Mhm,
not a lot of people care about that. So, and then I walked away from that review of thinking like, I think a lot of people are missing covering a lot of things. And I think I have one of the best and most in depth recaps on YouTube where I'm
mhm.
covering like my cost basis, like increases or reductions. I'm covering like one of the things I started this year is like, what did I start the year with? What did I end last month with? And what did I end this month with? That way you can trend that growth of like the number of shares, the average number of shares, my projected annual dividend income, like all the things.
Mhm.
So it's just really hard like with all that stuff. And like you said with the channel, that would be cool. Is if in 10 years the YouTube channel is making me more than I'm making in income, and I can quote unquote retire, or and then in my day job, and I can quote unquote retire and do this, and this doesn't feel like work. And like you said, being financially independent doesn't necessarily mean waking up at noon and going to bed at 2 a.m. and not doing anything. It's just the
Yeah.
freedom to do whatever I want. If I wanted to get a part-time job as a personal trainer just to help kids understand the
Mhm.
importance of moving right and moving often, like all these things, because we know how everybody's going now, where everybody's just being less and less active, and everybody's getting bigger and bigger, and the health's getting worse and worse, and all those things. And if I can, maybe I'm 50, I retire, and I do that, and I can go in and teach the kids, or maybe I'm going into nursing homes and helping them like do some things, whatever. Like at that point,
Mhm.
the pay doesn't matter. It's just whatever I feel like doing that helps me feel good.
Exactly, and
So
that's one of the biggest things. That's why I always talk about retirement. For instance, I'm not like my daughters. I'm not per se teaching them to quote unquote save for retirement. I'm teaching them to invest for financial freedom.
mhm.
So if they have a 401k, they have offers to match. And by all means, you get the match. Then you max out your Roth, but their custodial account is a regular brokerage account.
Yep.
So they're able to grow their funds at a very, very fast rate. And because of like companies that have a lower yield, they have a substantially more capital appreciation.
Mm-hmm.
So all that capital appreciation is you can get without having to pay taxes, even in a quote unquote taxable account.
Yeah.
And I always use the saying, I said all accounts technically are taxable accounts. The question is, when are you going to pay the taxes, and at what rate are you going to pay the taxes?
Yeah.
Most people just pay the rate, wait until they're 60 to pay taxes, but then they pay at a higher rate because the government says, thank you for, number one, giving us access to your money, so you can't get your money, so you got to work for us until you're 60. And now we're going to charge you the highest tax rate because we held it for you, and you're going to be taxed as ordinary income.
Yeah.
Whereas the money in your brokerage account is taxed at the long-term capital gains rate, which is less.
Yeah.
And because it's basically the tax code is written really for people for investors more so than for people employees.
Yeah, well, you got to figure like the people that are writing these codes and approving these laws, 90. I don't even know what. I'm assuming all of them invest. There, how many of them get booked for insider trading all the time?
Mm-hmm.
Like Nancy Pelosi, and she's like, "Oh, I didn't technically buy it; my husband bought it." I'm like, "Yeah, you guys don't talk like that." like I don't know, all kinds of stuff like that. And I'm just like, so I actually stopped talking about what I was talking about. So like, I have the approach of 50 to 59 and a half is my taxable account, and if I can make it those 9.5 years, at 59 and a half, my HSA, my 401k, and my Roth come into play. And then I can wait until I think it's 70. I can wait until I'm 70 to pull from Social Security at the latest.
Mm-hmm.
And then I'm getting the maximum, I think it's like 112% benefit from Social Security. So then it's like I call it like my horseman approach, where it's just like, okay, if you can ride this horse all the way to this checkpoint, you're going to get some reinforcements over here. And then if you can take those horses to the next checkpoint, you're going to get even more reinforcements. So like, in addition to my 10% plus dividend raises that I'm getting, I'm going to have account reinforcements coming in if I can just make it those 10 years or 9.5 years technically or whatever. So
exactly.
That's my style. And I don't know, like I'm excited about it. I have all the numbers, like everybody that I talk to that's been in the game for a while, they're like, hey, you're on the right path. It's going to work for you. And like, that gives me the confidence with it. But like, you don't know it doesn't work until it doesn't work, right? Like
exactly.
If I get there and I'm 50 years old and I'm like, well, I'm only making I'm only making $30,000 a year in passive income. I'm like, I obviously can't live off of that. That stinks. But that's also a part-time job that I'm not working.
Exactly.
So, I mean, worst case scenario, I'm going to make a couple $1,000s extra if it doesn't
over
work.
Over 20 years, because of the way money compounds, your money is going to grow. When you get to, like, by all calculations for me, it's like between years 8 and 12 when it like begins supercharging, because you've doubled your money if it's 18%, or technically even at 15% of your money doubles about every 5 years. So about 10 years your money's doubled twice. So it's on its third doubling cycle. So when it gets to the point where it's doubled two times, and then you go to 15 years, it's doubled 3 times. If you had $1,000 a year, when it goes from 1,000 to 2,000 to 4,000 to 8,000 to 16,000, those doubling factors really, really start kicking in, a whole lot faster once you get to that particular point.
Mm-hmm.
So if you can just be patient and see you got the really good companies and they start compounding at a rate that's where your income starts growing at such a rate, because everybody talk about the hockey stick, it goes like this and this, and all of a sudden it just starts
shoots right up.
Yeah, exactly. And Buffett made most of his wealth after the age of 50 because of the company. He had this, you have this floor here, and then it starts getting up here, then it gets higher and higher, and then the compounding component it grows at the same rate, but the money just grows faster because it's a higher dollar amount.
Mm-hmm.
And if you at 10,000 and it doubles to 20, then 40, then 80, then 160. You can go from 80 to 160 in the same time frame it took you to go from 10 to 20.
Yeah.
Just because of the growth rate.
And that's why I say, how do I know when enough's enough? Because at the end of that thing, that's when those bars are big. And I'm just like, man, if I just wait 4 more years, that's going to double, say less.
Exactly.
I can do that.
You would know based upon your own lifestyle at that particular point in time, what your own goals and desires are. And it's going to be different for every person. Mm-hmm. You would know. If you get to a certain point, you'd be like, you know what? That's it. I'm good. You would know. Now, if you want to have the ability to do extra stuff like the travel and stuff, so I have my income portion, but then I also look at the companies that may or may not pay dividends in the future. I say, oh, you know what? Let's go to such and such. Let me sell $10,000 worth of Amazon, $10,000 worth of Nvidia. Let's pay for this trip. From that. We're gonna call this the Amazon trip or Nvidia trip.
Yeah, well, let's go see the Amazon.
Exactly. And I don't have to sacrifice my income. Those would be like luxury things. So we'll see how those continue to grow in the future
Yeah,
too.
that's a cool way to think about it too. I mean, the only stock I have that doesn't pay dividends in my main two accounts, which would be my Roth and my brokerage, is Tesla, and that's in my Roth because of the tax advantage. That's going to grow, for free. So
Mhm.
that's really cool.
Yeah.
And like my Roth is all ETFs, and then my taxable is all my individual stocks because I want, like you said, I want that control to be able
Mhm.
to understand what's in there, if it's growing, if it's meeting my needs or not. Versus
Mhm.
the ETF, like I think they said that there's 7 stocks that are bringing up the S&P 500 this year. Other ways it's negative, like it's the Apples, the Microsofts, the Teslas, the Nvidia,
Yeah.
Netflix, yeah,
Yeah.
Facebook stuff. I think there was 7 of them that
Maybe.
has like most of the gains in the S&P 500 this year.
Yeah. And
So
I think let's see. I think my daughters own pretty much all, all of them
yeah,
in their account. I don't. One company I don't own that I don't own Microsoft. It's a great company. I'll own it probably in the future. But at the same time, the ones that I do own, just because of the compounding aspect of it, I add Microsoft in the future. Maybe in Adobe because I have like in my daughter's custodial account, like about them Adobe a while. And it's the same thing because of fractional shares. Just buy if you put in $50 in a month, I can put $5 in 10 different companies every single month and just continue to grow and continue to build. That's one thing they'll learn by doing this is that all you got to do is just keep on adding. Now you have great companies, you keep adding, and that's the reason why I prefer individual companies. I know I don't say I know, but I know. I mean, until I'm proven otherwise by actual results, that owning a group of really good companies chosen are going to outperform the index over a long period of time. And mine is it's been 7 years. I've done it over the last 7 years. It's probably even longer, but Charles Schwab just updated. I can't go back before 2016.
yeah,
Well, my outperformance of the index is probably longer, but it grows wider. It grows wider by the companies that I
yeah,
own. Like the companies you talk about that controls the index, those are the ones I own. So over time, those great companies tend to continue to perform at a level that's higher. And you'll notice it in your brokerage account over the course of the next couple of years. You'll notice your brokerage account is growing faster than the account that has the ETFs in it,
yeah,
in your Roth. And you'll notice like, you know what? Maybe, that for me, that was the thing. Like I looked at the accounts and how it's growing. I'm like, these companies collectively, not just one company, but collectively, because basically you're creating your own ETF,
yeah,
technically, your
yeah.
own index fund with the companies that you want. But yours, you don't have the AT&T like the regular index has. You don't have any of these Verizons or uh,
You get to cherry pick the companies. You don't have to own all the bad ones.
exactly,
Yeah,
exactly. And like I said, I don't have this fear that I'm gonna. I know that like IPR that I own is roughly down 50%. One company, if you have a bunch of group company, a bunch of different companies, one company is not going to destroy your portfolio. That was one of the things too. I was always afraid, like, oh, everybody says, if you only have 10 companies and then one company has a bad year, it's going to bring your whole portfolio down. No, it doesn't. I've had, I own 15 companies, and last year, or even with it being down, because the good companies continue to perform and they bring up whatever,
yeah,
whatever
yeah.
the quote unquote bad companies are not doing.
I mean, they're not technically wrong because, like, say you're performing at 20% because 14 out of your 15 are better, and one of them's down. If that one was also where the other ones were, you might be at 25%, but you're not
Yeah,
negative
that's
because
just
of that one
yeah,
company. But so
yeah,
again, like I said in many other interviews, it's all the opportunity cost. Like
yeah.
it's not necessarily that something's right or wrong. It's just the only wrong decision's no decision.
Mm-hmm.
And the interview that came out
Or
today, if you're
AT&T.
watching this, do what?
I said or AT&T.
Yeah, or AT&T and Verizon. Those are wrong decisions. So today is June 25th when they're recording this. So the interview with Dave just came out, And he said that, and he's been doing this for 25 years, and he said that his biggest mistake has always been selling. And he goes, it's never been what he bought. He's bought some losers, he's bought some winners. He goes, his biggest mistake was selling. And that's really something to really think about, is like, even if you bought a company and it no longer meets, and I might actually do this, like say Illinois Toolworks doesn't meet, I do a deeper dive on it, it doesn't meet what I'm going for. I don't necessarily need to sell that because it did meet at one point. I can just say from now on, I'm not adding any more money to that one and just let it run, because it has been compounding for the last 2 years, and just let it do its thing and just say, okay, ITW, you're going to sit over there to the side. You can do your thing, and I'm going to focus on a new position from now. Because yeah, I mean, what happens if I sell it and then all of a sudden, you know, my Nvidia thing happens again where I sold it and I was just like, yeah, Nvidia doesn't meet my thing, and I sell it and it goes up 25%.
That's one thing I've done since I have these notebooks. So since 2019, every investment decision that I've made is written down. So if I bought one company, if I sold one company and bought another one, it's written down in the notebook. That way I can always go back and I can compare, like, did I make a sound decision? You know, when I did this, every time I buy a stock or if I go in and buy a group, it's written down. And so I do that for a couple of reasons, because if you're just willing to just buy and sell and buy, there's no way to go back. There's no way to look and see how you're actually doing, other than you can look at your performance and you can see like your growth rate, the compound annual growth rate. But I want to look at the decisions that I made and look at them and see, did I make a good, rational, sound decision? And by me documenting everything, I'm able to go back and look and say, okay, this was the right decision, you know, that I made. Or, you know, if I didn't make the right decision, then okay, why didn't I make the right decision? So how can I make a better decision going forward? And by me documenting everything and holding everything and looking at it from that standpoint, also the notebooks that I have, that's material that can be left behind. So wherever I'm going and my daughters are looking at it, they can be like, okay, now I'm learning more from investing by not just at the decisions that I made, but also the notes that I write in the book. So they see, okay, this is why my dad did this decision. This is why he sold AT&T here, and this is why he used the money to buy XYZ company. Yeah. This is why he first bought. I started in 2019. I think what happens is the more I started learning, the more I started, when I stopped the trading aspect of it. And I say I want to document what I'm doing, because I'm just just doing stuff without really having anything to lean back on, like any test to tell me that I'm doing things correctly. You know, they always say in school you teach the lesson and then you give a test afterwards. In life, you take the test and then you learn the lesson afterwards.
Yep.
So the same way with investing. You're investing, and then you might not learn, you know, for whether it's you selling the company, you might not learn for 2 years or something. Like Infinity, you learn in about 2 weeks.
Yeah. A week. I think it was a week.
Yeah, so you might not learn to years later whether or not that was around a good sound decision. So I write my notes in there about, you know, my belief that, you know, the best way is just to buy good companies and own them. You know, every year, January right now, I still see no reason to change my philosophy. This has been my rate of return for the last 7 years. My performance, my portfolio is still performing at a rate greater than the index collectively, not 1 year versus the next year, but collectively over a long period of time. This is where I started, and this is where I am now. And there's so much hope for the future.
Yeah. I agree with all that stuff. It's just like the writing it down. I have a stock philosophy tab on my spreadsheet. But it's really, I just made check boxes and I put like, does it, you know, meet my 3 criteria, and I checked the box if it did. But I think I might do that on my spreadsheet where I actually have a tab. It's still called the stock psychology, but it's going to it's going to literally go step by step down each one and say, Apple, why do I own Apple? And I'm basically selling my future self on why to keep Apple. And that way, you know, in 10 years, say Apple goes down 50% because somebody did something, like, I can look back and read that, like, do these things still apply? Is this still true? And if it is still true, I'm at a 50% discount. I can go buy it. So I like that idea. So you gave me 2 things to think about. Okay, so last question for you, and then I'll let both of us get on with our night. I appreciate your time too.
This has been great. This has been great, because I always think that, like, you can learn so much from different people. Like, I have this quest for knowledge. I always want to learn. So anytime I can talk about something like this, you don't lose knowledge by sharing it. Your knowledge actually grows
Mm-hmm.
because the more you talk about it, the more it becomes part of your long term
Yep.
memory. And then the next time you see something or hear something, it would like you would recall this. I would recall this conversation and then pick up bits and pieces. I'm always trying to pick up bits and pieces from different. Even when I post stuff in the group, I'm always trying to pick up bits and pieces from other people's philosophy. My philosophy didn't come just from mine; came from studying Warren Buffett and really Philip Fisher, his common stocks and uncommon profits. Like 90% of my philosophy comes from that book, and then also from studying Warren Buffett. Not to do what he did, but just to learn the philosophy
Mm-hmm.
on investing. Like, what is the philosophy for building wealth long term? Not to try and make rich quick. I'm not chasing penny stocks. I did that. That didn't turn out well.
Yeah, it never does. Yeah.
Oh no. So that, and then I did the buying and selling just quick. I hopped on the trends. That didn't end well. But the more I realized that, just buying the great companies, the truly outstanding company. That's what Phil Fisher talked about. You buy the truly outstanding companies and you stick with them through all the fluctuations in the gyrating market, then you're going to have more money or more people can benefit because it's a simple approach. If you can control yourself and you can identify, come up with like criteria, simple criteria, and that you're looking for, and it works. If it works for you, then it could be taught, it could be duplicated. You know, it's not like it's real complex.
Mm-hmm.
So keep it simple and then just continue to reach out and continue to try and help people. Some people will, some people won't. Actually, I was talking to somebody yesterday. And he actually set up a meeting like 2 weeks from now. He's like, "Look, we gotta sit down and talk. I'm meeting with him and his wife so we can kind of go over like this, like the aspects of what he needs to do, where he can learn more from what I am, and I can show him different aspects of what I'm doing and how it can benefit him
Mm-hmm.
because only the people can. I always said people, you don't really teach anybody anything. People learn because of their desire to learn.
Yeah.
So if you run up against a brick wall trying to talk to people about investing, then those people aren't desiring to learn. So you're not going to really teach them anything because they're not really, their ears are not open to acquire that type of knowledge. But there are some people who are going to come and start seeking you out because they're going to recognize that money is going to grow if it's invested. That's what made so many financial advisors look so smart from 2009 to 2021 because no matter where it was over time, the money was going to grow. Everybody like you gotta see my guy because he's making my money grow. I'm like, not doing anything special.
Yeah.
Somebody talked about like if you're a duck and you're in the water and then it's raining and it keeps raining and the water goes up and you keep rising up, eventually you might think it's you and you had nothing to do with it. It's just like the rain is causing everything to go up.
Yeah.
So, that's how I am with my investing. I say it's not me, it's not my brain power. It's just that I learned to identify a few good companies, and I have the fortitude to stick with them even when the stock prices depreciate.
Well, I think it was in Justin's interview. He had a really, really good quote that was like just a different way of thinking about it. And that's one of the things I take away from these conversations. Like you with the diversification, that's something that's going to stick in my head. Mm-hmm. And then what he said was that you're not necessarily trying to pick the companies that you think are good. You're trying to pick the companies that everybody else thinks are good. Mm-hmm. Because like at the end of the day, Apple has its moat. I'm not the only Apple customer. You're an Apple customer. My wife's an Apple customer. I know a bunch of other people that are in the Apple ecosystem. And you're just like, okay, I think Apple's good. But more importantly, everybody else thinks Apple's good. And that's how you make your money. And I was like, that's a really good way to think about it. It's just like, I know a lot of people that won't invest in some of the sin stocks, the Altrias and the Philip Morris and stuff like that. And that one it may be a bad example because like smoking's on the way down and stuff like that. But like back in the 80s, 90s, 2000s, you didn't need to believe in Altria. You just need to know that everybody else believed in Altria, and you would have made some good money.
Yeah.
So it's one of those things.
I think that was one of the companies that maybe it was Peter Lynch's book or one of his books, because I have both of them. He had talked about like over like a 30 or 40, Altria is like the best performing stock over a long period of time because it paid out a high rate as far as dividends, but it grew its dividend by a lot. And one of the reasons why they always had a higher yield was because people were always down on the stock. There's certain times when a company's stock can go down, the yield goes up, and it's not really a good investment. Ultra is one of the ones where every time there was a lawsuit that came up and the stock price went down, but they still were making so much money. Mm-hmm. They were able to pay out a high ratio because they weren't really they didn't have to put a lot of money back into it. They could just send a lot of money to their shareholders.
Yeah. Yeah, so that one, and like I said, when I do the filter for the Power Fives on Friday, like as soon as I add the filter for outperforming, most of them fall off. The ones that don't are very interesting to me. Not that I'm buying them, but for the reason behind the Power Five, and I don't think I do a great job of explaining this in the series, is like I say in the beginning, there's many different kinds of dividend investors. So like if you are an investor that is at the point in your life that you need the yield, there's a stock each week for you. If you're the type that likes longevity, there's a stock. If you like the dividend growth rates or the 10-year returns, or if you're like, hey, what stock's shown that it can support a high price and has recently come down? There's the highest percentage off the 52-week high. And I'm just like, I think the one that came out on Friday was, I don't remember. I think it was Dollar General or something. And Dollar General it was MetLife or Manulife. And that one used to be all the way up here. And it has great 10-year returns, including the drop. It was like up to 200,000, I think, at one point. And it has really good dividend growth rates. It has a really good dividend streak, all the things. And I'm just like, it just dropped. So is this a great buying opportunity? That's for you to decide. I just present you with the information. But all that to say, ABR was one I mentioned a couple weeks ago. That one has like an 11 or 12% yield and has outperformed the market. That's not normal. And it falls in the same line of Altria. Altria outperformed the market with an 8% yield. That's not normal. What is normal is AT&T and Verizon. Boom, got them again. Yeah, your 7% yields that get destroyed by the market. That's normal.
Exactly.
So, okay, yeah, last question. So to wrap things up, I have a reasonable hypothetical question for you. Someone watching now has been watching a lot of Dividend Obsession, a lot of my content, and they have finally decided to jump into dividend investing. They come to you asking for one piece of advice. What can you tell them to help them on their journey?
You know what I'm going to do? I'm gonna let me see. You know what? If I can. Nope. I went back to the other one. I'm going to do this from Philip Fisher, from Common Stocks and Uncommon Profits. And there's one quote that I post a lot when it's part of the book. I forgot what page it's on. When it's talked about yield, like the dividend yield. This paragraph that he says, I'm gonna read this paragraph, and then you go from there. It says, actually, dividend consideration should be given the least, not the most, weight by those desiring to select outstanding stocks. Perhaps the most peculiar aspect of this much discussed subject of dividends is that those giving them the least consideration usually end up getting the best dividend return. Worthy of repetition here is that over a span of 5 to 10 years, the best dividend results will come not from the high yield stocks, but from those with the relatively low yield. So profitable are the results of the ventures opened up by exceptional managements that while they continue the policy of paying out a low proportion of current earnings, the actual number of dollars paid out progressively exceed what could have been obtained from high-yield shares. Why shouldn't this logical and natural trend continue in the future? So the point being that over a 5 to 10 year period, you have the same philosophy. Those with the lower yield, because of their ability to grow their dividends, those are going to end up paying you the most money over the long term. You're going to end up with the most in terms of dollar amount. So I would say don't get caught up in chasing yield, because he also said in the book that most retail investors can't live off the yield alone because their portfolio value is not great enough. Mm-hmm. So the results come from either having a couple of hundred or maybe a couple of $1,000 a year starting right now, or income much, much greater in the future. So you have to decide whether or not you want that current income or you're looking for a greater income in the future. And if you're willing to be patient and you're willing to reinvest the dividends, you're willing to take time to learn what separates a good company that can grow its dividends and it's going to grow your income over time versus one that's just looking this paying a high yield. You're looking for this big income based upon yield, then you're going to be a lot better off in the long term looking for looking truly for the outstanding business that can grow their income and grow their dividends over time. So don't chase yield and think for yourself. Don't follow the crowd. Don't just buy a stock because I said it or Troy said it on his channel or I'm trying to remember that name you said with the CFA behind it.
Oh, Joseph Hogue.
Yeah, yeah. Joseph said it. Don't just buy a stock because they say it. Take your time, do your research because if I say buy a stock and then Troy comes along and says, no, that's not a good stock, who are you gonna listen to?
Yeah.
If Joseph comes along and says, oh, you should buy this, you should buy, who are you gonna listen to if you don't have your own set of criteria? So you gotta learn to think for yourself, and you're gonna have more conviction if you do think for yourself and you're gonna stick with your conviction and you don't have to try and prove other people wrong or right based upon your decisions. So just look at making sure you're making good quality decisions based upon your own research, and don't try to spend time looking over hundreds of different stocks. It's only because most of your growth is going to probably come from 3 or 4 stocks that you own anyway.
Yeah.
You know,
I
as
I
opposed
could
to
honestly argue that if you have criteria and you're filtering stocks and you get to a point where your filters yield you 100 or 200 stocks to look through, your filters aren't tight enough.
yeah, exactly.
Like I said, when I did my filters on for Costco, my most recent purchase, there was 2 or 3 stocks on that list. I had to
Mm-hmm.
look through 2 or 3 different companies out of the ones that met my criteria. And again, your criteria being tight enough does not mean you need to add more criteria or more complex criteria. It could be quite as simple as changing your dividend growth rate. Like say you filter 1, 3, 5, and 10 years by
Mm-hmm.
6% and you get 200 stocks. Upping it to 7% might get you to 20 stocks.
Mm-hmm.
Like literally something that small. And like that's another thing is like if you're having filters and tracking progress are so underrated. Like you need to have criteria that your stuff meets, and you need to have progress that, or you need to have a way to track your progress, because if you're just out here wandering through the caves in the darkness and you don't know which way you're going, if you never see a light, you're never getting out. Like
Awesome.
you're just in there, like, and you have to be able to track it. I always say this. I say this on my channel all the time. When you are first starting in dividend investing, focus on the percentages, not the yield percentages, but your growth percentages.
Mm-hmm.
You'll see one year you made $1 in May. The next year you made $5 in May. That's a 500% increase. You're not going to do that probably ever again. But then the next year you go from $5 to $20. That's not
Mm-hmm.
a 500% increase, but your dollars are starting to get bigger. And then
Exactly.
eventually, when your percentages start to get so small, your dollar amounts will be bigger. And then you can switch your focus from the percentages to not changing anything you've done to get you there, but you can change your mindset to be like, okay, my percentages are smaller, but now I'm making 80, 90, 100, $200 a month in dividends. And now that's inspirational. Because like before, $1, $2, $5 isn't going to pay any bills that you have. But now you're making $100. You're like, okay, I can pay my cell phone bill and my water bill with that.
Yeah.
Now you're not going to, because you're reinvesting those dividends, but it's the point behind it. So like those are just some things I always say, and I agree with the yield thing. I agree with all the stuff that you were saying. I think that's super important for the new investors. Is just it's kind of funny because I ask everybody at the end of the interview that same question, and I think everybody has if they didn't just say just get started, it's always been don't chase yield.
Yeah.
And I'm not mad at it either, because what I want to happen is I want a collection of interviews from different people in different countries and different points in their journey that all understand the same thing. And maybe if there's 50 of us all saying the same thing, there will be an 18-year-old with a 30% yield on their portfolio that says, "Hey, maybe I need to do something different." And if we can change that one person, that's all I want from these interviews, is just like something that you said, something that I said sticks with one person. One person per interview is fine with me. More is better, but one person per interview, it changes. Either they get started and they weren't planning on it, or they change how they were doing things because they understand like, hey, these guys said that's not going to work. Let me look into why it won't work first of all, and two, let me adapt a new way that will work. And then you can like that. The difference between doing that now or never seeing this interview and never doing it could cost you hundreds of thousands or millions of dollars in your life.
That's true.
And that concludes another insightful episode of Dividend Discussion. I hope you found inspiration and valuable takeaways from our engaging conversation. If you're hungry for more dividend investing wisdom, be sure to subscribe to Dividend Obsession and hit that notification bell to stay up to date with my latest interviews, tips, and strategies. Remember, the journey to financial independence is a marathon, not a sprint. Keep applying the lessons you've learned and stay committed to growing your wealth using dividends. Together, we can create a community of dividend investors sharing knowledge and supporting one another. If you enjoyed this episode, don't hesitate to share it with other investors that are equally passionate about the power of dividends. Let's spread our dividend obsession far and wide. But until next time, see you.